Good morning and welcome everyone to day 2 of the 2024 ICAS Insolvency and Restructuring Conference. I'm Shona Campbell, Event Chair and Convener of the ICAS Insolvency Committee. I am an insolvency practitioner and head up the Business Recovery and Insolvency team at Henderson Loggie. So before we go any further in the day, first up we have a short video from our sponsors, Sweeney Kincaid. Thanks to Sweeney Kincaid, our sponsors. So, day 2. If you didn't make it yesterday, we had lots of stuff, 3.5 hours, quality CPD, corporate and personal legal updates, a session from Professor Russell Napier on financial lessons from history for the way we live today. We had an update from the insolvency monitors on common issues identified in the 2023 insolvency monitoring reviews. There was a session on the personal insolvency consultations that are underway in Scotland and England at the moment, and 2 sector in focus sessions, one on agriculture from Adele McLeod and Conor Bowles of Teneo, and then one from construction from agriculture from Richard Bathgate and Michelle Waugh from Johnson Carmichael. So the agenda today, first up in a couple of minutes, we have a tax update from Tony Cochrane and Rob Pullar of RSM, followed by Stuart Clubb's second corporate legal update. Then we have James Dewar from Interpath, who's going to be doing a section focus session on retail, and then a short coffee break before we start again at 11 o'clock sharp today with James Lloyd, and that will be the personal insolvency update. At 11:15, we've got David Meldrum from Assets looking at another sector in focus, this time care, followed by Callum Carmichael with our final sector in focus session, which is on fisheries. Our last session of the day, 11:55, when we will have a panel session with the 5 sector in focus presenters. So lots of good stuff coming in at just over 3 hours of more CPD. What more do you want? So our first section today is tax. We have Tony Cochrane and Robert Pullar from RSM. Tony is an associate director and VAT expert, and Rob Pullar is corporate tax. So over to Tony to start us off.
Thanks, Shona. Good to be here today with my colleague Rob. And today we're going to talk about all things tax and VAT, but very quickly, just to make sure we keep on time. So I'm going to kick off today's session, and that's going to cover off some VAT points. The VAT points today are going to be around option to tax, partial exemption, and bad debt relief. And then Rob's going to cover off some tax points, loss carryback, sale of capital allowances, and sale of group relief. So I want to cover off quite a bit today within the whistle stop tour, so I'll just crack straight into it. The first thing I want to cover off is the VAT option to tax. And by default, most land and property is exempt from VAT, and people are usually keen to make it taxable if they can, and they can do that with commercial property by opting to tax. What you're essentially doing is flipping something that's VAT exempt to become taxable at the 20% standard rate. The real driver for this normally is to facilitate VAT recovery, to get the VAT back on your day-to-day expenditure, or if you're buying a property, get the VAT back on the chunky VAT bill, or if you're undertaking a refurbishment of a property, that's when people are keen to opt to tax typically. And, big numbers can be involved with these sorts of projects. So it always makes sense to at least think about opting to tax, whatever stage you are in the life cycle of a property, including you guys as IPs and LPAs. It's interesting to just think about, well, what is the option to tax position? And, if I can't find out clearly, what should I do? Do I want to opt to tax in the situation I've got? But in terms of opting to tax, there's two very straightforward in principle parts to it. Number one is making that decision to opt to tax the property. And the second part is notifying HMRC about your decision to opt to tax the property. And these days, it's all done by email, whereby you send an email to HMRC with a form attached. Now, there's a few forms that can be used for an option to tax, but the one that most of the people on this call will be thinking of is the VAT 1614A. And that's the standard option to tax form that covers most situations, but always best to check in with someone that's a VAT specialist just to make sure you're filling in the right form. Now, the practical issue that you'll have is, well, is there an option to tax? You get involved in a situation where you've just been appointed to a case, there's land and property assets, and it's unclear if there's an option to tax in place. Right away, I can tell you if you're involved in residential stuff, almost certainly it doesn't apply. You can opt to tax land and property, but it only really affects commercial properties. So what you can do is you can get in touch with HMRC and just ask them to confirm if there's an option to tax in place against the VAT number for the case you're involved in. And the good news is that these days HMRC will still respond to you. I can't promise how quickly they'll respond, but they should still respond to you. That's not the case for everyone. HMRC tightened up the rules about, let's say, a year and a half ago. So from the 1st of February 2023, not everyone could correspond with HMRC to obtain that certainty. But the good news is that IPs certainly still can get in touch. As I alluded to, HMRC's response time can possibly be an issue, although in principle they've got a lower caseload in front of them to deal with. It doesn't necessarily mean that you're getting a very quick, robust service from HMRC, and I'm sure that many on this conference today have that experience. But there's also the point to think about, if it's unclear, well, right now, do we want an option to tax in place? You can consider, submitting an option to tax notification to HMRC to draw a line in the sand in situations where, you think there's an option, all evidence points towards an option, but belt and braces, we can submit one with a covering email setting everything out, and that should be enough to allow you to charge VAT, etc., when you're selling on the property asset. Now, it is worth just, underlining this point. You can opt to tax. It's not a situation where you're stuck with what you've inherited. A common, incorrect philosophy around opting to tax is the option covers a building or a piece of land. It doesn't. If we're being strict about it, it covers a VAT registration's interest in a piece of property or land. So I could opt to tax a piece of land, sell it on to Robert, and he might not opt to tax the same piece of land. It will only take effect for the VAT number it's involved with and the entity it's involved with, broadly speaking. So it's worth pointing out again that, option to tax is about land-related supplies. I'm renting property, I'm selling property. You don't really need to worry about opting to tax if you, for example, buy a property and you operate a shop from it. Your VAT recovery will be driven by the activity of that shop. There's not a need to opt to tax if you're simply using a property for your other purpose. But it is worth considering opting to tax in your case when you guys get involved, because we want to generally make sure we're minimising VAT recovery restrictions as far as possible, so there's as much funds available for the case as possible. So for example, if I was to sell a property tomorrow on an exempt basis, when the legal fees come in, the VAT's strictly speaking non-recoverable. I can do some checks to see if it's allowed via partial exemption, de minimis rules, etc., etc. But broadly speaking, the rule of thumb is if I've got an exempt transaction, I can't get the VAT back, or I should budget on that basis. So it certainly is worth thinking about this at an early stage. It can also affect, office holder fees, etc., etc. So, it is important to kick the tires on an option to tax, but before you do make that decision and before you do notify HMRC of what you're doing, think about the bigger picture. Is the other side willing to pay VAT on top of their property or land purchase? Think about their VAT recovery position. Think about the additional LBTT costs if it's a property up in Scotland. Just have a little think about it before you pull the trigger on making the decision to opt to tax and going through with notifying HMRC about it. Now, if you do decide we're clear on this, we want to opt to tax, that's the plan. As I said a few moments ago, you email HMRC with the prescribed form, normally VAT 1614A, and you explain, the details in the email of what's broadly happening. But the most important thing nowadays is that you include the full property address, including the postcode and effective date of your option to tax in the subject line. And personally speaking, I always also add in the VAT number and the business name too. That means that when you get an email back from HMRC a couple of minutes later, kind of like an out of office reply, that's your only evidence these days to show that you have notified HMRC of an option to tax. Some of us are more experienced will remember you used to submit the notification and HMRC would send a letter to you explaining, we have acknowledged your option to tax, etc., or queried it. But nowadays, if it's all acceptable, HMRC don't have a reason to get in touch. The only communication will be your email with the form to HMRC and one or two auto emails you'll get back within the next couple of minutes. It's important to save this stuff in the file as you would with all other information, such as the VAT return stuff, just to make sure you've got that full body of evidence should HMRC or anyone else ever challenge it. A practical example actually would be if you're selling as part of a TOGC, the other side solicitors might say, oh, can we have evidence of your option to tax? So it's really valuable that you've got this information. Moving on from the option to tax side of things to partial exemption, it is important to just, think about how does our VAT recovery look for a case? There is a connection, a nexus between the option to tax and partial exemption. As I said, when you're opting to tax, you're transferring something from being an exempt activity for VAT purposes over to being a taxable activity. And very broadly, taxable activities are good for VAT in the sense that whilst you account for VAT on your outputs, your sales, that opens the door to typically getting VAT recovery on your expenditure. Conversely, if you're fully exempt, you get no VAT recovery, and if you're partially exempt, you get some VAT recovery. So just linking back to the option to tax for a moment, that's one of the drivers for opting to tax, to remain fully taxable for VAT recovery on a case. We'll come on to some more examples in a moment, but just very quickly, you might have a fully taxable business for VAT purposes. It recovered all its VAT on expenditure. When you guys get involved, you might find you've got property that by default is exempt as it's not been opted to tax. And as such, what happens is you've actually got to worry about VAT restrictions if you don't opt. Whereas if you opt, that means you've got all your VAT recovery on the case, broadly speaking. So partial exemption is all about VAT recovery. You will have an obligation to do some calculations if you have got a mixture of taxable and exempt income to work out how much of your VAT on expenditure you can get back. And it may well result in some VAT recovery restrictions at the end of the day. Exempt activities include things like, renting out property that's commercial but you've not opted to tax, or selling the same. And also things like selling flats or renting houses. Because they're residential, they're always typically exempt from VAT. That said, there are some exceptions, not on the slide here, but if you're involved in a case where you've got, a housing development, for example, the sale of new houses can be zero rated for VAT purposes. There's a difference between the zero rate and exempt. From an outputs perspective, no VAT's getting charged. But from an inputs perspective, you get VAT recovery on zero rated transactions. So if you sell a new house, you can zero rate your supply, get your VAT recovery. And that includes complete houses that are new, but also what I would call quotation marks golden brick, whereby they've been constructed to a sufficient level, whereby it's above ground level, etc., and it's classified as the sale of a new house and can be zero rated rather than exempt. And we have seen that in practice when we've been advising people as something to keep an eye out for. Don't jump the gun and assume that something has to be an exempt sale if it's residential. The option to tax won't help you out, but things like the golden brick rules might. Now, partial exemption, as I said, should be considered at an early stage. What's the VAT recovery position looking like for the case as a whole? It is a big impact on VAT recovery having exempt activities, and it will influence your decisions, such as the example I gave a moment ago about opting to tax property. I think what's really valuable this morning, just very quickly in a moment, I'm going to run through some examples of where HMRC sit with this stuff, because it's not always clear. Partial exemption is tricky. It is complex. It's why VAT advisors have jobs in a lot of cases. But just really quickly today, I just want to cover off some examples with you guys. And the first couple are where you're continuing to trade, fully taxable business continues to trade, the VAT is recoverable on your office holder fees and other expenditure. If you get a partially exempt business continuing to trade, then you should expect some VAT recovery restrictions to apply, which would have been the case before you got involved anyway. Separately, if you've got the situations where cease to trade applies, so you've got a fully taxable business, ceases to trade, but then partially exempt because some of the assets are exempt, well, all of the VAT is actually recoverable on the office holder fees. The VAT restriction is essentially ring-fenced to the new exempt stuff that's happening, such as an unopted property sale, an office block that you don't opt to tax. That's a really important one, I think, because it basically means there's a line in the sand for the office holder fees that says, look, fully taxable business, full VAT recovery here. We just need to worry about the VAT restriction on the stuff we are doing that's exempt, essentially. And if you've got a partially exempt business that ceases to trade and sell assets, again, VAT restrictions probably will apply when you do your VAT recovery calculations for partial exemption purposes. The final topic I'm going to do a whistle-stop tour of today is bad debt relief. Bad debt relief opportunities should be considered by IPs. It's really important to consider them. Whether or not you have any joy with bad debt relief is another matter, but you should always consider whether there's an opportunity here. And essentially, bad debt relief applies when the business has paid VAT to HMRC, but they've not been paid within 6 months of the due date by their customer. The rules essentially mean that you can claim back from HMRC the VAT that you've paid over, but you have not received. So in principle, you're out of pocket for 6 months from the due date, but you can get it back from HMRC, and that does include insolvency cases. Now, in principle, this all balances out for HMRC in a theoretical world because the customer should repay the VAT it's claimed from HMRC or not claimed it at all in these situations. And whether that's the truth and really stacks up in real life, I very much doubt it, but that's the principle that really helps facilitate bad debt relief claims. Now, to claim bad debt relief, you must satisfy various conditions. So there's a little bit of an exercise involved. So, as I said, that's got to have been accounted for to HMRC. You've then got to write off the debt in your day-to-day VAT accounts and transfer it over to a bad debt account. You can't have inflated supplies values, and the debt must not be, sold on, factored, etc. Now, if the debt is unpaid, for 6 months, it's about the due date and the date of supply, but typically speaking, it's a payment due date we see in practice at VAT advisors. And in terms of time limits, similar to the normal rules for VAT error corrections, be it in your favour or HMRC's favour, there's a 4-year rule at apply, but in practice it's 4 years and 6 months of the later of the payment due date or the date of the supply. Now, when can you make a bad debt relief claim when you've ticked all those boxes? Well, how do you do it? You can do it on your VAT return. You make an adjustment in your VAT return to essentially benefit from the VAT bad debt relief credit. That's assuming that the VAT registration is open. If it's not, you can do a claim on a VAT 426 form, as you would with other types of input tax deductions that you might have on a case. You should share information with HMRC to support the claim, and that will be all the evidence you've got. Essentially you'll have your letter setting out, here's a schedule of, the transactions, here's the copies of invoices, etc., etc. And just a very quick comment, actually, it's worth pointing out that if you ever get paid again by your customer, you just make another adjustment. So you don't get to have your cake and eat it, claim the bad debt relief and then you get a little bit of a windfall. That doesn't work. The reason for having the separate bad debt relief account is just so you can keep a track on it and repay if necessary. Now, I'm going to pass you over to my colleague Rob, who's going to cover off some direct tax matters.
Thanks, Tony. Just as a way of an introduction, I'm Rob Pullar. I'm a director in RSM's M&A tax team. A lot of my focus is on transactions, so both positive transactions, positive M&A, and looking at distressed businesses. So that's both distressed sales, debt rationalizations, carve-outs, and we do a lot of helping our in-house restructuring team on insolvent businesses and winding those up. What I want to talk today about was how to convert some tax assets into cash for the business. A lot of businesses will have tax assets such as losses and capital allowances, and a lot of the time these go to waste when a business is struck off or is insolvent. They do have cash value, but unless they're utilised in the correct way, what tends to happen is these assets will just be lost to the void, and there'll be no cash received for those. So I was going to talk through sort of 3 simple ways where these assets can be converted into actual cash for the liquidation. Throughout sort of all 3 of these methods, I think there's this sort of 2 overarching problems. One is access to information. A lot of time we'll be supporting a liquidator post-appointment, and therefore record keeping pre-appointment will be difficult, and therefore a lot of what we do is piecing together the history and what we can do in terms of the tax position for the period pre-appointment. And in addition, I think the first question we always ask is it worth it? You can do a lot to sort of convert some of these assets back to cash repayments, but quite a lot of the time they'll be lost because HMRC will be owed so much money that it's not worth it. So I think before we ever start these, looking at how to generate some cash, we also have to consider, is the information available? And even if we were to generate cash, is that of any use to the insolvency? The first one we're going to start on is probably a fairly simple one. I assume most of you who have in-house tax teams have probably done this several times. That's a loss carryback. So what happens is a company generates tax losses. That's when expenses exceed the income of a business. In trading companies and solvent companies, these are generally carried forward and offset against tax liabilities in future periods. Where we get to with insolvent businesses and liquidations is that if these losses are not used at the point the company ceases to trade, then they're essentially lost and there'll be they can't get used to offset tax. However, what HMRC will allow you to do is any losses generated in the last 12 months of trading can be carried back 3 years against taxable profits of that business. I think what we always need to piece out here, and what sort of benefit of that is the losses will essentially disappear if they're not used. So you essentially will get back 19% or 25% of any losses if there's sufficient profits in previous periods. So sort of the opportunity here, and what you need to look out for, is where a company has been profit making for several years and leading up to the insolvency, leading up to the cessation of trade, it has suddenly become loss-making. You often see that when there's sort of third-party events that pushes a business into insolvency, so where it's out of the business's hands. So quite often if something happens further up the supply chain and this business has been profitable and no longer is viable, or interest rate increases, etc., where it sort of tips the business from profitable to loss making. So we've had a fair amount of success looking at this position, piecing it together to get cash back for liquidations for our team. The next one I was going to look at is the sale of capital allowances. So capital allowances, for those who don't know, are the tax relief on the purchase of fixed assets. So essentially it's tax depreciation. If you buy plant and machinery, or if you buy fixtures and fittings, the company will get relief either on day one under certain conditions, or as the capital allowances, as the asset is amortized. So essentially you'll get 25% relief for any capital spend, but it may be spread out over several years. So what happens at the end of each balance sheet year is that there'll be a pile, what's known as capital allowances pool. So this is unamortized, unrelieved capital spend that gets carried forward each year, and it'll get amortized, and in each year you'll get a tax deduction. What happens is, where the opportunity here is the sale of commercial properties where there's losses in the selling entity. So when you sell a commercial property, you can elect on a Section 198 election, which essentially says, when we sell this commercial property, we will be transferring X amount of value of capital allowances to the buyer. And what that happens is the capital allowances gets transferred to the buyer can then take tax relief for those capital allowances. So if you put on the form £100,000 of capital allowances, that will get transferred to the buyer, and the buyer will get £25,000 of tax relief over the course of that asset's life. But that also increases the sales proceeds in the seller. So it has an equal and opposite reaction, therefore it increases the tax position of the seller. Therefore, I assume most of you have sold property, and there'll be a Section 198 election buried at the back of any asset sale agreement that the lawyers normally put £1 in. That's probably the sensible answer, to put £1 in for solvent businesses, because that doesn't crystallize a tax charge anywhere. It moves the business without creating too much havoc, and the seller keeps any tax relief going forward and doesn't crystallize an additional gain. However, with insolvent businesses, there's often tax losses to be utilized. So what happens, what's often the opportunity is transferring some of the capital allowances from the buyer to the seller on commercial property, and electing for as much of the capital allowances to be transferred as possible. This will increase the gain in the seller, give further relief in the buyer, but what will be offset is any brought forward losses in the seller. So if you've got £1 million of losses, and you assign £1 million of capital allowances to the buyer, that will increase your sales proceeds by £1 million. Therefore, that would be 250 grand of tax in most sort of solvent businesses. However, because you've got that £1 million of losses to offset, that's never going to get utilised again. Those losses are offset. There's no actual cash payment to be made in the seller, and the buyer gets an additional 250 grand of deductions in future periods. And the value that can be achieved for liquidation is one of two things. It's either it just intangibly increases the value and the desirability of the property. If you can tell a buyer that, as well as getting this property, you get X amount of tax relief going forward, that helps get the sale across the line, helps you get a better price. But you can also directly assign value to capital allowances. So when we've done it in the past, we've sort of assigned 50p in the pound or 25p in the pound for any capital allowances transferred, and that's sort of documented in the sale and purchase agreement. That will come in as an additional payment as part of the sale. It'll increase the tax payable, it'll increase the tax with profits, it'll get offset by losses, and then all parties are in a better position, and that's more cash for the insolvency. And fundamentally, what it does, it uses up the capital allowances that would go to waste if the business has been liquidated. It also uses up any losses carried forward that would go to waste if the business has been liquidated. So that is quite useful in utilising tax assets there. And I think the final point I want to talk about is the sale of group relief. So for those who don't know, group relief is where a business, two businesses in a corporate group can claim and surrender losses from each other. So business A makes a profit of £1 million, business B makes a loss of £500,000. It can surrender that £500,000 to business A, and therefore it reduces business A's tax bill. What we have seen and what we've done a few times is for periods pre-appointment, because the liquidation breaks a group relief group. So we've seen it where a company has been appointed over, a liquidator has been appointed over a subsidiary of a company. It's then responsible for filing the tax returns of that subsidiary. It's the liquidator has to approve all tax returns. However, tax returns tend to get done, 12, 18 months after the accounting period, especially slower if it's in liquidation. Therefore, other members of the group may want to utilise those losses generated by the subsidiary that's been put into liquidation. And what we've done is, as liquidator, in order to sign the pre-appointment tax returns, we've assigned a value to that. So if there's 100 grand of tax relief, we've asked the former group companies to pay 50p in the pound. So if they give us, for every pound of tax relief they get, they'll pay the liquidator 50p, and therefore they're up. So they've got tax relief that they wouldn't have otherwise had, and we've got rid of some losses that would have gone to waste if the business has been left to run and go into liquidation without utilising those assets. So again, what you need to look out for there is where one or two members of a corporate group have gone into liquidation, the tax returns are not up to date yet, and therefore there's a group relief surrender to be made by a company in liquidation for a pre-appointment period. And that's where you can then sell those tax losses to other group companies. So I think that's where I've wanted to cover off, which is trying to utilise any tax assets into cash for the liquidation. So that gives us 10 minutes left, and Tony and I were going to do a Q&A. So happy to field any questions from now.
Okay, thanks. So we have got a couple of questions through already, and if anyone else has some questions, please type them in the chat, and we'll ask our experts, tax experts here. So first one that we have is a VAT question relating to bad debt relief. Tony, if a company has been deregistered for VAT and bad debt relief claimed, and then the debt is subsequently recovered, how do we declare VAT to HMRC? Is it on a VAT 33, but somebody's given a proposed answer?
Yeah, thanks, Shona. My quick answer is no, it wouldn't be a VAT 833, at least as a starting point. The reason for that is HMRC take quite a strict view of what the 833 should be used for. So I would be against just assuming that you could use the 833 for that. Essentially, the 833 form is how you pay output tax to HMRC, the VAT on income. When you're selling goods in satisfaction of a debt. That's the broad headline news. And HMRC are very rigid in their approach to when an 833 can be used, even to their detriment. Unfortunately, although I'm telling you that that's what you shouldn't do, it's unclear what you should do. I think that's on purpose. HMRC don't explicitly spell it out in any of their guidance that I'm aware of anyway. What I think you would do in that situation, if someone asked me that today in a live case, is I would email the appropriate team at HMRC and ask what their preference is. I've seen the past examples where, rightly or wrongly, it's been via an 833 or a way of marking it down on a 426 form, so make the adjustment on there. So there's a kind of an offset. But I would suggest sans clear guidance in HMRC's website or notice 756, etc. I would recommend that you just essentially email the appropriate team at HMRC, and that will change depending on the type of case you're working on.
Okay, and another question then that comes sort of related a bit to that is just generally, how are you finding service levels from HMRC across the different strands? Is there any themes, improvements?
Well, from a VAT perspective, I've certainly seen improvements. I wouldn't say naturally that means it's great right now either, but I think it has got much better. I've been involved in insolvency VAT for more than 10 years now, and I sound like a right old man here, but I remember the good old days where it was really clear and qualified staff who were very pragmatic and helpful. And now it's a bit of a lucky dip, which is unfortunate, and you sometimes question how knowledgeable the staff you're dealing with are. That's when you get a hold of someone. And in terms of general timescales, I think it is getting better. A lot of people on this conference will remember HMRC's issues with processing VAT 769s when you got involved in a case. And if that bit worked, they struggled to get a VAT return out the door. And if you're really lucky, the first two parts work, they really struggle to accept the VAT return once it came back to them. I think we're seeing improvements with all these things. So I think they are getting better generally with how they work it. And I think they are getting more efficient too. But I feel it could be much better. But maybe I'm a little bit biased. I want everything to be much better for you guys when you're going about your daily business.
Yeah. And Rob, do you have any comments on the service levels with regard to the corporation tax?
Yeah. I'd probably agree with Tony. It's slightly recovered from the lows of COVID, to be honest. It's starting to get a bit better, but they're never the most responsive people in the world. So I think that's why just trying to get your ducks in a row and presenting a simple case to HMRC as possible is always the best approach.
Okay, thanks. Another question here. Will sale of capital allowances be more relevant going forward now that we have and are expecting full expensing to be made permanent?
So I think the relevance of full expensing will mean that there's no tax pools carried forward. So I think the tax assets in terms of capital allowances and the sale of businesses sale of property is the capital allowances pool, so that's unused capital allowances going forward, and any brought forward losses. There won't be any capital allowances pool to shelter the gains created by selling capital allowances. Therefore, it is very dependent on, to be able to get value from this, it'll be much more dependent on the losses brought forward than the capital allowances pool. So because there'll be no pools, any capital allowances sales will create a much bigger tax charge, which will need sheltered by the losses. So it probably limits this slightly to where there's big enough losses to shelter any increased gain.
Okay, thanks. Tony, you mentioned the VAT notice 756. Could you just elaborate on what that is? I'm not sure that everybody might be aware of that. I think we should be, but it would be helpful just to overview what that is and what it does.
Yeah, absolutely. So VAT Notice 756 is essentially the VAT Bible in HMRC's eyes for practitioners and anyone with an interest in VAT on insolvency. So Notice 756 covers off the rules that are specific to insolvency cases. And it's also a nice practical guide in a lot of ways. For example, it tells you who to contact depending on the type of case you're dealing with. And it also just gives some reassurance on here's what the basic rules are. And in addition, because you guys are so lucky, here's the little quirks that you've got that are a bit different from day-to-day normal VAT world for a lot of businesses. For example, paper returns died out for many businesses several years ago, as did, sending forms physically to HMRC, etc. Whereas in the insolvency world, it's still acceptable to submit paper returns and things like that. So there are little quirks and nuances with insolvency VAT. And what's really useful is Notice 756. It acts as a little bit of a guide to a lot of general rules with the add-on comments on here's what you need to do in practice. And it will also refer to other pieces of VAT guidance that you can rely on. For example, I mentioned the option to tax stuff earlier on, or partial exemption or bad debt relief. if you look at the 756 guidance, it'll give you a fairly nice summary, and then it will signpost you over to here's where you can go and get some additional information to read up on if that's how you want to spend an evening. But I would say in practice, if you have got colleagues that work in tax, that specialist or general tax, it's always worth just collaborating with them and saying, look, does this sound right? You know, am I doing something that's sensible here? Equally, if you've not got colleagues that specialise in tax or that, you know, it's worth reaching out to people like Rob or myself, and we're always happy to give people a bit of an idea of what needs to be done. And, you know, we do, you know, essentially give advice to a lot of people in the marketplace to help with that, because we appreciate that not everyone wants to be a VAT expert or a tax expert, and maybe they don't have enough experience with it. So just having that reassurance can be helpful sometimes. But yeah, Notice 756 is the VAT Bible in HMRC's eyes for insolvency VAT. Thanks.
And you can just Google VAT 700/56 and you'll probably find it. So that's where that's. Is there anything, Rob, with corporate tax and that sort of similar Bible where you get your complete guide to everything to do with corporate tax and insolvency?
No, sadly you don't. I think the main differences from insolvency to sort of regular corporation tax is all about debt rationalizations as well, and it's all about making sure losses are used, etc., pre-appointment. So it's spread across various HMRC's guidance, but there's not consolidated in one place.
Okay, thanks. Just David in the chat box is saying, and remember, HMRC technical manuals are good sources of information. I always find it quite difficult to find exactly which bit of the technical manual I'm supposed to be looking at, but I guess that's where I need to speak to my taxation experts. So we don't have any more questions. I don't know if there's any final points that the two of you would like to make before we move on to the next session.
No, nothing from me.
Yes, same.
Okay, well, thank you very much for doing that. That was really helpful. Like you say, tax can be a bit dry in some people's minds, but it is a really important thing in insolvency. And I know just with what you're saying about the VAT is not on my transactions, but I do know that quite often it's just at the end of the transaction somebody suddenly thinks, oh, what about VAT? So it's always a good idea to get the ducks lined up in a row as early as possible. So thank you for that. And we now are moving on to our next session, which is our Stuart Clubb, who has been doing this for 13 years now, partner and solicitor advocate with Shoesmiths based in Edinburgh, current chair of the Edinburgh Insolvency Discussion Group. Yeah, so Stuart's he did his the top 10 of corporate insolvency cases. We had 10 to 6 yesterday, and today we have the final countdown from 5 to number 1. So let's hear what Stuart's top 5 cases are.
Thanks, Shona, and welcome to part 2 of this year's corporate insolvency legal update. As you'll know from yesterday, we're counting down the top 10 corporate insolvency cases of the last year. So let's get right to it and find out what's at number 5. And it's the decision of Lord Sanderson in the Court of Session from October last year in the case of ATE Farms Limited against AW Estates Scotland Limited in administration. In summary, the owners of a paper mill in Aberdeenshire went into administration, and the administrators then decided to sell the paper mill and entered into negotiations for its sale to ATE Farms. As part of those negotiations, the parties entered into a deposit and exclusivity agreement which provided for a £300,000 deposit to be paid and for parties to act towards each other in good faith and to diligently and expeditiously progress the negotiation and conclusion of the sale contract on the terms set out in the heads of terms, which terms had already been agreed between the parties. So far, so straightforward, and the parties started progressing the negotiation of the sale contract. However, negotiations hit a snag when the administrator sought to include an indemnity which required the purchasers to indemnify them in respect of all environmental liabilities covering both the paper mill which was being purchased and another separate site which wasn't part of the sale. Negotiations broke down, the sale fell through, and the purchaser then looked to recover their deposit on the basis that the administrators had breached this clause by insisting on an indemnity which was wider than that agreed in the heads of terms. In looking at the clause itself, Lord Sanderson considered that it placed two separate duties on the administrators. Firstly, a general duty to act towards the purchaser in good faith, and secondly, a specific duty to diligently and expeditiously progress the negotiation and conclusion of the sale on the basis of the heads of terms. And Lord Sanderson found that providing an indemnity in the wide terms sought by the administrators was not a requirement of the heads of terms. But was it a breach of these two duties imposed on the administrators by this clause? Well, in relation to the general duty to act in good faith, the judge found that it wasn't, and that the administrators wanted the deal to proceed just as much as the purchaser did, and they genuinely thought they were entitled to insist on this indemnity. However, the judge did find that it was a breach of the specific duty, as there was no obligation in the heads of terms to grant the wide indemnity sought. By demanding it, the administrators were in breach of their obligation to diligently and expeditiously progress the sale on the basis of the heads of terms. The pursuer was therefore successful, and the deposit fell to be returned to them. And the key takeaway from this case is therefore not so much any issues around the principle of seeking indemnities when selling assets in insolvent estates. That's fairly standard. It is instead the need for IPs to ensure that any indemnities which they are seeking are set out to the fullest extent possible in any heads of terms. At number 4, it's a decision of Lord Braid from back in March in the case of Turnbull petitioner, which serves as a useful reminder of both when a shareholder can seek a winding up order and the just and equitable winding up ground. Now, Mr. Turnbull was a minority shareholder, and he presented a petition to wind up the company under section 122(1)(g) of the Insolvency Act on the basis that it was just and equitable, which was opposed by the company and its directors. In summary, Mr. Turnbull's petition raised a number of complaints as regards how the company was being managed by the board, and these circumstances were such, he argued, that it was just and equitable that the company be wound up. And the petition raised two issues which Lord Braid had to consider. Firstly, whether Mr. Turnbull had an interest to present the petition, and secondly, whether he had in any event averred relevant circumstances which would justify a just and equitable winding up. In terms of interest, Lord Braid set out the general rule, namely that a shareholder seeking a winding up order had to be able to establish that the company was solvent and that there would be a surplus remaining for distribution to them after payment of the company's debts and the costs of the liquidation. As such, a shareholder would not generally be permitted to petition for the winding up of an insolvent company. Now, it was accepted that this was a general, not an absolute rule, but a shareholder has to be able to demonstrate some tangible benefit in order to have a sufficient interest to bring a winding up petition. However, Mr. Turnbull's averments in that regard were plainly insufficient to overcome that general rule, and for that reason alone, his petition failed. And on the question of whether he had, in any event, averred relevant circumstances to justify a just and equitable winding up, Lord Braid held that he had not. And in reaching that decision, Lord Braid gives a very useful summary and reminder of the just and equitable winding up ground, going through the well-recognised examples, such as company deadlock. We also recognise that the remedy may be granted in any situation where it's just and equitable to do so. However, Mr. Turnbull's complaints, which were said to be of the nature of a domestic squabble over the manner in which the business of the company is being conducted, didn't amount to such a situation. This decision is an interesting one and certainly one to have to hand for the next time you're asked to give advice on a just and equitable winding up. And we're staying with Lord Braid for our next entry at number 3, and that's the note by sportsdirect.com Retail Limited in the administration of Goals Soccer Centres plc from November last year. This was a somewhat unusual case concerning an application by a significant unsecured creditor for the removal of the existing administrators and for the appointment of a replacement administrator under paragraphs 88 and 95 respectively of Schedule B1. Now, what had happened was that during the course of the administration, the administrators had identified potential claims against the company's directors and auditors, but with no funds to pursue those claims, they'd been assigned to the noter. The administrators then considered that the purpose of the administration had been achieved and they wanted to dissolve the company, whereas the noter wanted further investigations to be carried out and therefore they considered that the company should exit to a CVL. And it was that disagreement over the appropriate exit route which led to this application being made. Now, the administrators didn't oppose the application, and nor did they lodge answers, and their position was that they were neutral as to whether or not it should be granted. Their solicitors did, however, send a letter to the court for Lord Braid's attention, making informal representations on the application, and I'll come back to that letter shortly. Interestingly, this case is a Scottish first because there were no previous Scottish authorities on the power to remove administrators under Para 88. Plenty of English authorities, but this was the first Scottish one. And in summary, with reference to those English authorities, Lord Braid said that there has to be a good and sufficient reason for making a removal order, and that the court should be slow to do so if it might open the floodgates to a flurry of removal applications. However, in the very particular and unusual circumstances of this case, including the fact that the administrators themselves had no wish to continue in office and were neutral on the application, Lord Braid granted the order sought. Now, I did say I was going to come back to that later, which was sent to the court by the administrator solicitors, making informal representations on the note. And in my view, Lord Braid's comments on this letter are actually the most interesting part of the decision. Although the letter stated that the administrators were taking a neutral stance, it went on to set out various concerns they had as to the purpose and effect of the application, and amongst other things, actually appeared to present an argument that no good reason had been shown for their removal. Now, to say that Lord Braid wasn't impressed with representations being made by the administrators in this way would be something of an understatement. Despite the administrator's assertion of neutrality, he saw this letter as being apparently a backdoor attempt to be heard in opposition to the application. His view was that officers of the court, such as administrators, who are legally represented, are well able to lodge answers and to instruct counsel, and if they wish to be heard in opposition to a petition or to advance reasons as to why it shouldn't be granted, that's the course they should take. And as such, he attached no weight to this letter. Now, if for no other reason than this being the first Scottish authority on removal of administrators, this case was always going to be worthy of inclusion in this year's chart. But I think the more interesting takeaway from this case is around how IP should and should not engage with the court if they want to make representations in an application. In short, the key takeaway is to lodge answers. And now to the second last entry on our countdown, and yet another decision of Lord Braid, this time in the note by the joint administrators of Alexander Ingalls and Son Limited from February of this year. And this was a case where the purpose of the administration had been achieved, and the administrators were now looking to place the company into liquidation and to be appointed as liquidators. And therefore presented a note to the court seeking a number of orders, including that the company be wound up and that they be appointed as joint liquidators, as well as an order that their remuneration be fixed at 20% of the value of the assets recovered in the liquidation. Now, I've heard this case described as having something for everyone because it deals with not just one, but with three interesting legal questions. Firstly, whether it was competent to apply for a winding up order by way of note rather than petition. Answer, yes, it was. Secondly, whether in winding up the company, the court had to appoint an interim liquidator first. Answer, no, it didn't, as the legislative intention was to bypass the trouble and expense which would be incurred if an interim liquidator had to be appointed first. And finally, you had to consider whether an order should be granted fixing the liquidator's remuneration at 20% of the value of the assets recovered in the liquidation. Now, the rationale for the notary seeking this order was said to be that it would enable them to make further distributions to creditors without delay, avoid the need to form a liquidation committee, and avoid the expense of a court application for approval of remuneration. In addition, they said that the fee of 20% was appropriate because it took into account the risk that they may not recover any assets and may therefore not be entitled to any remuneration. However, for various reasons, Lord Braid wasn't willing to grant this order. Firstly, and most fundamentally, he didn't consider it to be competent to do so, as the rules don't permit a claim for remuneration to be made before the work in question has been done. Secondly, even if it were competent, he didn't consider that it would be appropriate to fix the remuneration in advance, with there being no basis on which the court could assess whether 20% would represent fair remuneration for the work carried out. And finally, he remained to be satisfied that a fee of 20% wouldn't result in a disproportionately high remuneration. He said that if the court has been asked to fix the liquidator's remuneration, that requires to be done at the appropriate time, which is not now. A decision can only be reached in the future in light of all the circumstances. Now we're almost there, but before we reveal what case has made this year's #1 spot, here's a quick recap of the chart so far. At number 10, it was a case concerning shadow directorship and breach of duties. At number 9, we had confirmation that there were no grounds for restricting recoveries in a breach of duty case to the amount of the shortfall. At number 8, we had a case concerning the validity of an administration appointment. At 7, it was who is a secured creditor for the purpose of an admin extension. And we ended yesterday with number 6, confirmation that administrator was not an officer for the purposes of redundancy legislation. At number 5, we saw the importance of spelling out indemnities and heads of terms. At 4, it was a look at the just and equitable winding up ground. At 3, it was the first Scottish decision on the removal of administrators. And as we've just seen at 2, it was the administration of Alexander Ingalls and Son. So let me keep you waiting no longer. At number 1, and this will perhaps come as no surprise, is of course the much anticipated High Court decision from back in June concerning the collapse of the BHS Group and the claims brought by the joint liquidators against the former directors for wrongful trading and misfeasance. I think it's safe to say that no corporate insolvency decision this year has generated quite as many headlines as this one, and not just legal headlines either. Perhaps not surprising given that the collapse of BHS back in 2016 was one of the most high-profile corporate insolvencies of recent times. But beyond the media headlines, what was this decision about? Why is it significant for IPs and lawyers? Well, as I mentioned, it concerns claims against the former directors for both wrongful trading and misfeasance. And I should also say it's a very lengthy judgment. It's 533 pages long, and that's not even counting the separate August judgment. So it's not possible to cover every aspect of the decision in the very short time we've got today. And it's also a very fact-specific and detail-heavy case. So I'm going to only be able to summarise what I consider to be some of the key points under each head of claim, starting with the wrongful trading claim. Firstly, wrongful trading cases are extremely rare, and as the judge confirmed, the bar is a very high one. Under Section 214 of the Insolvency Act, directors can be ordered to make a contribution to the company's assets if at some time before the commencement of the winding up, they knew or ought to have concluded that there was no reasonable prospect that the company would avoid going into insolvent liquidation. And here the judge found that the directors knew or ought to have known that formal insolvency was inevitable from September 2015, almost 8 months before the group went into admin in April 2016. And between that date and the date of the admin, the increase in the net asset deficiency was £45 million, which the judge described as both the starting point and the upper limit for any wrongful trading contribution. Now, there is still a defence available if the court is satisfied that the directors took every step with a view to minimising the potential loss to the company's creditors, but that was a high hurdle to overcome. And while taking and acting upon professional advice is a very relevant factor when considering whether directors have fulfilled their duties, it's not a get-out-of-jail-free card either, as it's the duty and responsibility of the directors themselves to decide whether there was a reasonable prospect of avoiding insolvent liquidation. And ultimately here, the court didn't consider the defence to have been made out. 2 of the directors were ordered to contribute £6.5 million each, and a third director ordered to pay £21.5 million towards the company's assets. And the judge also rejected an argument that their liability should be limited or capped by reference to the level of their directors' and officers' cover or by their means to pay. And separately, there was the misfeasance and breach of duty claims. Now, the leading case on the scope of the duty owed to creditors of companies in financial distress is the Supreme Court decision in Sequana from 2022, which established that the director's duty to consider the interest of creditors is engaged where the directors know or ought to know that the company is insolvent or bordering on insolvency, or that formal solvency is probable. And here the court found that the duty to consider the interests of BHS's creditors had arisen by June 2015 and that it had been breached. The judge said that this case provided a good example of the insolvency deepening activity which had been discussed in the Sequana case. But why the 2 different dates of September 2015 for wrongful trading and June 2015 for misfeasance trading? Well, in summary, it's the difference between an insolvent liquidation being probable and it being inevitable, and the 2 claims are not mutually exclusive. And in a separate judgment issued just last month, the court found two of the directors jointly and severally liable to pay over £110 million under this head of claim. So very significant sums of money and a very significant decision worthy of the top spot on this year's chart. So there we have it, my take on the top 10 corporate insolvency cases of the last 12 months. Thank you all for watching. Enjoy the rest of the conference, and back to you, Shona.
Thanks, Stuart. Our next session is our third sector in focus, this time retail. We have James Dewar from Interpath. James is a chartered accountant and licensed insolvency practitioner. He is very experienced in supporting corporates, lenders, other stakeholders in a range of restructuring and turnaround scenarios. He's based in Edinburgh and he also leads Interpath's pension covenant practice for the Scottish region. Welcome, James.
Morning, everyone. Thanks for those kind words. Interesting you mentioned pensions. I'm glad to say there's no pension content at all on this presentation today. Instead, I'm going to speak about retail, kicking off a little bit about what's happening in the sector and some of the issues that retailers are grappling with. Then I'm going to go on to present a case study which will highlight some of the practical issues that insolvency practitioners face on insolvency. Okay, so the next slide, thank you. So top left, you can see a little graph of the number of retail insolvencies across the UK. There's over 2,000 per annum, now back up to pre-pandemic levels. And I've put kind of a selection of particularly some of the Scottish retail cases on screen there. Some of you may have worked on these. It's a kind of an observation is it's quite a wide church in retail. There's fashion retailers such as M&Co and Wilkies. Come on to Wilkies later on in this presentation. There's convenience, Eddie's food stores there, home furnishings, some of the names in the bottom right corner there. And indeed some online only retailers have also faced restructuring challenges in the last while. There's Tots Bots. If you know, you know. If you don't, well, go and Google it. No slide would be complete without a shopping centre on it. Retail real estate has also been a kind of an associated sector with the high street challenges. There's a number of shopping centre failures as well, be it into or more locally the East Kilbride one on screen just now. So why is it that the retail sector gives the restructuring and insolvency world so much work? I guess it's been facing a number of structural challenges in recent years. The graph there tells its own story. This is the percentage of total retail sales that are happening online. And from a very low base 20 years ago, now £1 out of every 4 is spent online. There's a question as to whether that pattern will continue, that will the online continue to grow. I don't think you can extrapolate too much out of one statistic, but it's interesting that in March 2024, the overall share online went slightly down compared to March 23. There's certainly a lot of discussion in the retail sector that an omni-channel approach, clicks and mortar, if you like, is the way ahead, and those retailers that embrace both online and a physical presence will do well going forward. Having said that, online does win where there's a specific niche. Appliances online, certainly eating Curry's breakfast, pun fully intended, sorry for that. Amazon as well is obviously taking over the world. Why does it do so well? Well, I guess it hits the what consumers are wanting, price, service and range. They may not have it all their own way, however. I've put a couple other logos on screen there, Shein and Temu. So Far East competitors with supplying directly into the UK market. So it'll be really interesting to see how that pans out. A couple other things that are affecting the sector on a structural basis. The rise of the supermarkets, well documented, probably taken that pretty much as far as it's going to go. And then within some subsectors, what we're seeing is those at the top end, luxury goods markets are doing very well. And at the bottom end of the market, discounters have also done very well over the last while. It's the bit in the middle that companies are struggling. Do they go up or do they go down? Being in the middle probably doesn't sit that well as a long-term solution. Got a little graph, so I thought I'd give you 4 on this slide. And this sets out some of the cost pressures, and these aren't unique to the retail sector, but they certainly do impact the sector. Start off at the top left. The living wage is going up to £12.10 as of April next year. That equates to £22,000 for a 35-hour week. Secondly, energy costs. That's a graph that will be familiar to many on this call. So it's obviously come down off its peak, but still costs are higher than they were back in 2021. And bottom left-hand corner, the Bank of England base rate. So money was essentially free for the last 15 years. It's not free now. Base rate's up about 5%, which means any retailers that have a leveraged model need to pay more an extra cost into their P&L and cash flow. In the bottom right, I've put a graph that shows the growth in the UK economy over the last few years, or rather the absence of growth. In general terms, the retail sector is aligned to how the overall UK economy is doing. If people have spare cash in their pocket, a chunk of them will spend it. So that graph shows that the UK growth has been very limited over the last piece, and that's not a great backdrop for any retail business to operate from. Throw into the mix Brexit, shipping challenges, although that's kind of largely resolved now. Overall, it's been a pretty challenging time on the high street in recent years. But I guess that's not really new news to the folk in this call. What we're seeing is that retailers are generally quite a creative bunch, and they usually find ways to keep on going through the hard times. And that takes us neatly on to the case study. So this is an administration case we were involved with last year. It's there's a lot of what I'm going to say is an element of grannies and eggs here. Many of this folk in this call will have dealt with retail insolvencies themselves, but I thought it'd be helpful just to revisit some of the key practical areas that you face. And this is quite a good study because it covers both a pre-packaged sale of half the business plus an orderly wind down through administration of the other half. So there's a Wilkie's store. Always good to get a picture. It had 11 units, all based in Scotland, in mid-market towns. So if you like, Kirkcaldy, Largs, Helensburgh, decent-sized towns. Some of them quite affluent. It sold ladies' wear, with also a bit of menswear, and it had a cook shop in all of its stores. Family owned, bought out in 2002, and a really strong management team, really hands-on. To be fair, they struggled for a number of years, but had always been just on the right side of break even, and that's a big credit to that management team. There's some of their initiatives that you can see in the orange boxes across the bottom. They did explore all avenues to make the business a success, including setting up their own website, creating a customer database that they pumped out email promotions regularly. Cost side, they opened stores, closed stores, seats, saw what worked, saw what didn't, and overall it was super tight cost control. However, it's a good spot, thank you. So what happened next was COVID hit, and like many other businesses, there was a whole bunch of support packages in place to help Wilkie's and indeed other retailers. The job retention scheme paid their wages, a bounce back loan taken out to help with cash flow, forbearance from landlords, rates relief, and so on and so forth. So overall, it was very successful. Wilkie's pulled through the pandemic and came out in pretty good shape. And even post-pandemic, there was a bounce as people who'd wanted to go and spend money in the high street had money in their pocket and were able to do so. So the first kind of 3 to 6 months post-pandemic, the Wilkies did quite well. Thereafter, some of the cost pressures that I've spoken about, be it labour costs, energy costs, started to bite. All of a sudden, suppliers wanted paid, no rates relief there, the bank wanting its bounce back loan paid back, and combined with margins getting squeezed and losses accruing, a funding requirement popped up. So what do you do when you get a funding requirement? Jumping ahead there we go. So this is quite a busy slide, so let me talk you through it. On the left-hand side are the various options that were available to the company at that time. The middle column sets out some of the issues with those options in old-fashioned red, amber, green. The issues are in red, not so much in green there. They're relating to the potential outcome associated with the final option that was taken out. So I'll go through these one at a time. The business could have sought finance and traded on. However, that would have no impact at all on the problems it was facing. The problem was viability, profitability. All that would have done would have put a plaster over the cash flow problems. It could have also made the creditor position worse with a secured creditor in place, ranking ahead of all of the suppliers and other unsecured creditors. Final point there would be how much debt could the business have taken on, given that all of its shops were leasehold. A variant on that is number 2, shareholder equity. The family thought long and hard about putting more money into this business, but the risks were just considered to be too great, and so they decided not to throw any more money at it. Moving on to things that could have actually impacted the business itself. They thought about, what else can we do to improve profitability, cutting costs. But I think I've already said that this was a really lean business, and there's nothing material they could do in that front. Closing shops would have been an option. They had 11, but all 11 were there or thereabouts in terms of being break even. There weren't 2 or 3 disaster areas that they just closed that could preserve the good ones. And that was one of the reasons why a CBA was not considered viable. There wasn't a long list of creditor arrears, so you couldn't do a CBA to defeat the creditors. The leases terms were generally perceived as being okay, and so that wasn't an option. All that was left was to seek third-party solutions. And going into the third column there, what outcomes could have arisen by a marketing process? Well, top box, they could have sold the shares to a third party, therefore giving the family an exit. Middle box, they could have found someone to invest in the business, not so much debt, but someone with a way to introduce money to the business, but also to change its operations to help address that viability point. And if neither of them are available, then at least it would see whether there's any options for an assets sale to try to achieve a better outcome for creditors. So Interpath were appointed to help the company explore third-party solutions. We ran a full marketing process, went to a long list of trade suppliers, used our investor network, which is private equity houses, family houses, high net worth individuals. And we did receive a bit of interest from a small number of parties. We provided them with a full diligence pack for them to look through. The feedback, however, was that the business was too small for them, or alternatively, the geography didn't work for them. A lot of these were retailers that were existing operations in England, and it was just seen as being too remote up here. Others said there was no scope to cut costs, even if they crunched it with their existing business. Furthermore, there was an immediate working capital requirement as the business moved out of summer and into its autumn-winter collection. So at the closing date, only one offer was received, and that was from a related party. And the key points of that are on screen just now. The related party sale went ahead via a pre-pack administration. They took on 6 of the 11 leasehold premises, rescuing 62 jobs in the process. They took on the stock, and at those 6 stores, including the retention of title liability for that stock. They took on intellectual property and the customer credits as well, be that gift cards or credit returns. The PPAT was also perceived as being a lower process than traditional administration, and the only thing it didn't deal with is the residual business. We'll come on to that in a couple of slides' time. So what are the key points for insolvency practitioners? Well, where there's a pre-PAT, particularly to a related party, there's always a bit of scrutiny, leaving creditors behind. So for IPs, it's all about risk management. So going across the top there, we fully tested the market. There was no other offer available. We instructed independent valuations to say, well, what would the alternatives be for a wind down scenario? And the offer that was tabled clearly beat that option. And we got an independent examiner who endorsed the transaction. Thank you very much, Shona. Other independent examiners are available. The bottom row, we looked at alternative strategies that might have been available, be it a solvent wind down, an insolvent closure process. And the final conclusion there is that this was the best financial offer, taking into account all costs of the process and the creditors that the NewCo took on. So where the fun really started was in dealing with the residual business. We took office and had stock located across 5 leasehold premises from about 50 different suppliers, and we knew there was a bunch of ROT and concession claims involved there. So pretty much no assets, if you like, leasehold premises, and the only tangible asset being stock that, as I say, had a bunch of claims against it. So we had to move pretty quickly, and the key decision was: do we keep all 5 stores open and sell stock from situ? Do we consolidate those 5 into one store and sell from there? And that's ultimately what we did. And the third option would be to close all 5 and to pass to an auctioneer, a retail agent, to sell at auction. And arriving at that decision, we took into account the various things that are on screen just now. So I'll talk you through them in a clockwise direction, starting with landlord's hypothec, which for the eagle-eyed, you will see there's a typo there. So hypothec is a real security and can't just be ignored. It attaches to all owned movable assets. And the key word in this case is owned. So where you've got a bunch of stock that you don't know whether it's subject to ROT or concession claims. Some of it will be owned, some of it won't be owned because it's subject to the claims. So first thing to do is to engage with the landlords and say, well, look, you may well have a hypothec claim, but do we have any assets? And that takes you on to the second segment in the wheel, which is post-admin rent. There's well-established case law now that essentially means you've got to pay rent post-appointments. You can't escape it if you're using the premises. So you've got to move quickly. You don't have time to sit for a month going through every single item of stock to agree retention of title or otherwise. Third segment is stock movements. You try not to double handle stock. Moving stock about is expensive. You need people to package it up and then people to move it and then people to unpack it. And that doesn't really help anyone. So that's a key part in the process. Spoken about retention of title and consignment already. One of the key practical aspects there is you've got to make sure your tills can separate what's been sold per supplier, so that if you're selling ROT or consignment stock, you can account for it properly. And the final segment in the wheel is pricing strategy. And this is where you've got to use clutch control very carefully. If you discount, then obviously that's very helpful because it helps move the stock quickly, but it also puts a cap on what you're ultimately going to get for that stock. So what are the key points for IPs when you're going through a retail closure wind down? Well, quickly going through these, you can't avoid hypothec, spelled correctly this time, and post-admin rent. These are facts. You've got to face them head on and pick up with the landlords as early as possible. And that leads you into commercial agreements where you've got retention of title, consignment stock, and landlords' claims all over the same stock. It does make sense to engage with them and say, well, look, this is a pretty difficult position for everyone to be in here and to do deals. No one wants to end up in a lengthy legal dispute particularly where the sums involved are relatively minor. Velocity, so you've got to move quickly. Every day that you're holding that stock, you're incurring cost, be it labour, be it rent. So no hanging about. You've got to really get your sleeves rolled up and get stuck in. Know your numbers. What I mean by that is to get reporting systems in place so you know how you're getting on in relation to plan. That's very much getting daily till receipts, understanding your cost run rate. Take advice. So there's a whole bunch of good retail agents out there that can help you with this. The directors as well, they know their business inside out. So if you've got a good relationship with them, then absolutely take their advice on board. Next guy is very flexible there, doing a bit of yoga. So being prepared to change approach if necessary. If you're off plan for whatever reason, then you might have to change that clutch control and pricing to move stock quicker, or alternatively slower if you're ahead. Get creative. It's not always easy to shift stock from an administration. We had that deal of the day at the shop we kept open, and the good people of Kirkcaldy were shooed out of the store when we did the air fryer deal. So it's funny what works and what doesn't work. And the final point there is stay close to people, and by that I mean employees who are obviously going through a really difficult time. We as insolvency practitioners often get focused on numbers, but at its heart, there's people whose livelihoods have been affected, and doing our work with compassion is very important. So apologies, I've eaten into your coffee break. I certainly have overrun here, so I'll stop talking at this point and hand you back to Shona.
Thanks very much, James, for that practical insight into the case. A lot of interesting bits and pieces. James will be joining us for our panel session at 11:55. So if you've got any specific questions arising from his presentation, please put them in the chat. And now it's time for a coffee break. And a reminder that there is going to be an ICAS Insolvency and Restructuring in-person networking event on the 14th of November from 4:30. It's going to be at the Exchange, Royal Exchange Square in Glasgow, handy for the train station for those outside of Glasgow. A sign-up link on the screen during the break. So still to come this afternoon or later this morning, we've got James Lloyd with the personal insolvency update, 2 more sector and focus sessions, and then a panel session to round off the day. We'll be back at 11 AM. Hi, and welcome back to the last leg, the final stretch. So now for our final legal update from James Lloyd, partner at Harper McLeod. James heads up the firm's insolvency team and has advised on corporate and personal insolvency related matters for many years. He has one less year than Stuart Clubb when it comes to presenting the legal update here at the ICAS Insolvency and Restructuring Conference. So this is James's 12th year of presenting. So let's hear what he has to say.
Thank you, Shona, and good morning to you all again. I'm going to start off with a relatively quick case. Perhaps there's nothing much comes from it, but I thought I'd mention it for no better reason that during the course of the hearing, the debtor told me to piss off and told the sheriff that she was a disgrace, which is always a surefire, guaranteed way of getting what you want. But the kind of important reason why I'm mentioning it is that it's a case, I'll not mention case, a case for the accountant bankruptcy against AGE. And it was an action where we had originally been instructed to raise an action to eject the debtor on the basis that he owned the property on his own. He had originally held it with his wife. His wife has passed away, and there was a survivorship destination in the title. So to that extent, he was then the sole owner of the property, and the whole interest then, of course, vested in the accountant in bankruptcy. We had engaged with the debtor. He'd been a bit difficult to engage with, but he had a solicitor. We couldn't get anywhere, but during the course of those discussions with the solicitor, it turned out that the debtor had a son and we were told that the son had additional or special needs. And although the debtor seemed to be reasonably elderly, we thought, well, it's a family home, so that's the end of it. We'll have to apply for consent. We raised an action for consent, and there it called for a diet of debates back in July. The reason why I mention this case is that it was one that in the course of it, the debtor raised a number of points that we sometimes see debtors raising. So firstly, this was a case where the debtor was disputing the level of the debts. It was also a case where it was said that there was certain health issues. There was an issue about what the value of the property was, and then of course there was an averment about the debtor being able to, or having the right to sell the property himself. And it's a good case because the sheriff accepted that. I mentioned the case of accountant bankruptcy against Brooks yesterday, and as I say, I've mentioned this case before. In that case, the Sheriff Appeal Court held that where someone is disputing an action in which the trustee is looking for consent, the onus lies with them to specify a relevant case as to why consent should not be given. And in this case, the debtor didn't do that. But what was quite useful was because the sheriff also kind of picked off all these various defences and dealt with them quite quickly. And firstly, the sheriff agreed with me that there was an onus on the debtor to positively plead these cases, and they hadn't done it. In relation to the issue about the debt, it was one of these cases where the debtor had been sequestrated following a dispute with, I think he might have been some sort of plumbing contractor or building contractor. He carried out some work, had originally been sued for £10,000 because the work was defective, and then because he had been dealt with cases in his own and had embarked on a number of fruitless appeals, the final debt was in the region of £90,000. And notwithstanding that there were court orders to that effect, he was continuing to dispute the level of the debt, arguing, relying on English cases, that we hadn't produced a presumption of debt or an onus of debt, whatever that was. And this case is in contrast to the case that we dealt with yesterday. This was a case in which, whilst some aspects or one or two of the debts might have been open to dispute, the debts that were supported by the decrees were not in dispute at all. And so to that extent, the sheriff said, well, that's all irrelevant. We're not going to look behind this here. These debts are all established, therefore there's a reason for selling the property. The other factor that arose, and again, this is something that we see quite commonly, the debtor was disputing the value of the property. In this case, we said that the property was worth £160,000. The debtor said, no, it's only worth £120,000. But the point is that regardless, it doesn't really matter because the mortgage was, I think, less than £5,000. And therefore, it didn't matter. There was still plenty of money to pay the trustees, and therefore, pay the creditors, and therefore that wasn't a reason for refusing the order. The debtor also tried to argue that he was entitled to put the property in market himself, and he should be left to do that. Again, we quite often see debtors saying, I'll do that. Well, they've no right to do that because the property vests in the trustee, and they have no right to do that at all. So that was kicked out. And finally, in relation to the matter of the debtor's health, as often happens, the debtor made no averments at all about what his health conditions were. And interestingly, although we had been told that there was a child who had additional needs, there were no averments about the child at all. And indeed, it was only during the hearing that we turned out that the son was in his 50s and was living there at all, and indeed was sitting behind his dad in court offering guidance. So again, it's a sort of nonsense that we quite often have to deal with when dealing with these cases, but it's good to see that the sheriffs are generally not putting up with it, are following the case of Brooks, which, as I say, I think has been a big help to us. And so for that reason, the sheriff granted consent, and the debtor, I think, is shortly to be ejected, which will teach him right for being abuser to me and the sheriff. The next case that I wanted to chat about was a case that was issued in January this year by the Sheriff Appeal Court, and it's a case by Thomas Campbell McLaren. Tom McLaren is a trustee of Derek Drummond against Derek Drummond, and it's an interesting wee case, and the facts that come out are facts that are not are not uncommon. Because the background here was that the debtor was originally sequestrated in 2011 and a trustee was appointed. The trustee raised proceedings to sell the debtor's home, or rather raised proceedings to have the debtor ejected. And in December of 2011, the debtor, or rather the debtor's mother, was eventually able to come up with the sum of £23,000, which she used to settle matters. So she gave that to the trustee. The trustee then dismissed the case against her son, and all would have been well but for the fact that the son was then sequestrated in January 2012, with the date of sequestration having been shortly before the action was dismissed. So in that case, the trustee then of course went against the debtor's home, because the debtor was still living in the property, it was still vested in his name and there was equity in it. In this case, the debtor argued that the second trustee didn't have any interest in the property. He argued that title had been transferred to his mother. But when the court, the sheriff and then the sheriff appeal court had looked at it, they determined that that wasn't correct. Now, in this regard, it's important to bear in mind that when property vests in a trustee on sequestration being awarded, what they have in respect of heritable property is a use ad rem, which is a personal right in the property. They don't have a use in rem, which is a real right in the property. And the difference is an important one. And it's for that reason that we have releases to the register and steps taken to take title and all the rest to protect title. But in this particular case, it was held that what happened was that the first trustee had sold her rights to the mother, but her right was only a use ad rem. So it was only her right, her personal right in the property, and not a right in the property. And it was necessary for the mother, if she wanted to obtain a use in rem, to take further steps to acquire that right. And because she hadn't done that, because come the second sequestration, title still remained vested in the trustee, in the debtor, it therefore vested in the second trustee, and he was entitled to sell it. Now, as I say, this is it's an important point, because we've had a couple of cases for the accountant bankruptcy where there have been some issues about what it is that the trustee has actually done, or what the parties intended to do. And in one particular case that we dealt with for the AIB a number of years ago, the debtor was estranged from his wife, and was no longer living in the property that had been the family home. During the course of discussions, it was agreed that what would happen is that the wife would buy out the trustee's interest. She paid a sum of money, and what the trustee then did was issue a letter of abandonment. What then happened was later on the debtor was sequestrated again, and an issue arose about, well, what was the title position in respect of that property, because at that point it still remained in the name of the debtor. Now, and this is what I say, it's very important if you are dealing with debtors or spouses or third parties, and you agree specifically what it is to happen in respect of the trustee's interest, because in that case, what the wife thought, perhaps not unreasonably, was that she was buying the debtor's interest. Okay, as she was estranged from her husband at that point, and therefore wanted to have title herself. The trustee, on the other hand, thought that all he was doing was abandoning his interest, and thereafter leaving it to the debtor and the estranged wife to sort it out amongst themselves. Now, as I say, the matter hadn't been resolved by the time that the second sequestration came along, but what happened was that the estranged wife eventually raised a court action to find and declare that in fact she had bought the property and that she was entitled to have the trustee convey title to her. Now, that was a case. It was odd because I think I was acting for the trustee as the second trustee, and another firm was acting for the AIB as the first discharge trustee. And ultimately, I think on the advice of counsel the matter had to settle, because the correspondence wasn't especially clear as to what was agreed, and there was a risk that we might have lost, and that cost the AIB as first trustee money in paying out or making good the cost of that. So that's why I say it's crucial. I think that if you're going to be dealing with third parties, that you make it plain as you possibly can make it plain what the situation is to be. I've had another case came across my desk a few months back where I was asked to act for the debtor's spouse. And as I say, I had to give advice in that particular case that although the spouse had made a sum of money over to the trustee, she had no rights to the property itself. And again, it was made clear in the correspondence. The trustee in that case had done a good job of making it plain that all that she was going to be doing was abandoning her interest. So again, make sure that you do that. We have another couple of cases where we have a case before the Sheriff Appeal Court at the moment in which a debtor was sequestrated back in, I think it was actually 1999, and what had happened was that the debtor's sisters agreed that they would buy the property back from the trustee at a price of £25,000. This was back in 1994 when I was less fat than I currently am now. The money was paid over, but at the last minute the sisters' solicitor said to the AIB, look, for various reasons we don't want to take title at this time, we're happy for you to issue your usual letter of comfort, which the Accountant Bankruptcy took to be their usual, or at that time, a standard letter of abandonment. Some 11 years later, in fact more than that, I think the debtor was convicted of peddling drugs, and so a Proceeds of Crime Administrator was appointed, who then took it upon himself to take this property. The sisters come back on the scene to say, no, that's ours, and then raised an action to have the Accountant Bankruptcy reappointed with a view to having the AIB transfer title to them. Now, as I say, I'll not bore you with all the details, but in that particular case, that is one which we do expect will successfully defend, because the correspondence is quite clear, albeit had it been clearer at the time, it might have avoided the issue altogether. The only final point that I wanted to raise was that we are seeing a wee bit of an increase in the free men in the land coming back. I think we found they were more prevalent during the financial crisis, but we seem to see them more and more. We have one at the moment who's now designing herself as a baroness, which is entertaining. She's still sending screeds and screeds of correspondence to whoever bothered reading it, and therefore I think you have to be on your guard. We also had another case recently down in Dumfries where an ejection was arranged, and when the sheriff officers turned up, there was a group of free men all there stopping the sheriff officers taking steps to carry out the ejection. Ultimately, what had happened, or what has happened, is that there has to be quite expensive liaising with the police and sheriff officers and locksmiths to be able to do a dawn raid, get in, get the property secured, and then attach shutters to it to stop them moving back in. In that regard, if you ever have issues with free men in the land, let me know, because there's a very good case that deals with how you deal with them. And on the issue of shutters, it kind of brings me to my final old war story, which was many years ago. We ejected a woman in Airdrie, I think it was, and having ejected her, the trustee was then sent an estate agent round to the house to carry out an inspection with a view to preparing a marketing schedule. When the estate agent went into the house, he was surprised to learn, or surprised to discover, that the debtor was there, and she had moved back in. Apparently she had left a window open at the back when sheriff officers went away, and so she was able to climb back in and reoccupy. She had the audacity to ask the estate agent if he could leave her a key because she had difficulty getting in and out the front door. So in that particular case, what we did was we took the view that there was probably no point in getting an interdict because she was unlikely to observe it. So what we did was took the practical step of just instructing shutters to be put up. And what happened on that occasion was that basically this woman moved back in twice before we eventually came to that view. But on the morning when sheriff officers were carrying out this process, it took longer than anticipated, but a van drove up and it was the debtor's stepdad, who was not a happy man. I think he was expecting that his daughter might be able to break in again, and discovering that the shutters were going up, contacted us and agreed to pay sufficient money to pay off the debt, which we gratefully took. That having been done, he was then back on chasing us to get the shutters taken back down, and of course we had to wait some time, so he wasn't happy about that. But the final reason why he wasn't happy was he complained because the sheriff officers who had turned off the gas weren't Corgi registered. So I telephoned the sheriff officers, who said that, and this is your takeaway from today, that you don't have to be Corgi registered to disconnect gas. You just have to be Corgi registered to turn it back on. So on that basis, we phoned them back and told them to get stuffed. So on that, as I say, no doubt an appropriate note, I will pass you back to Shona.
Thank you, James. And now we have David Meldrum, who is going to talk to us about the care sector. David is a licensed insolvency practitioner with Assets. He's got 17 years of insolvency and restructuring experience, and outside of work is a keen golfer, although not very good, that's what he said, and a supporter of Clyde Football Club, also not very good. David.
Thank you for that introduction, Shona. Good morning to everyone watching, and as Shona said, I'm going to be speaking about the care sector with a specific focus on care for the elderly. This is a facet of the care sector that has experienced significant financial challenges over the last 10 years, and for which, unfortunately, the challenges seem to be growing, leading to a number of insolvencies, particularly amongst care home providers. I'm going to be discussing the cause of the financial issues, as well as some of the key considerations when being appointed to a care business, some of which I have some recent sector experience of through the management of 2 care businesses that Assets have been appointed to during the last 18 months, Balmano House and MHA Auchlacan. So Balmano House was a care home that historically had operated at full capacity. However, the business had started to experience cash flow difficulties due to inflationary cost increases and a rising reliance on agency staff. Whilst the company had the benefit of an unencumbered property asset, there was a lack of appetite from the lender to provide financing for further working capital, with care actually being seen as a high-risk sector for many lenders. Following a review of the financial position, unfortunately, the company decided that the business was not going to be sustainable beyond the short term and was going to experience cash flow difficulties without first entering administration. Now, we recognised quite early on that Balmano was going to be a difficult business to trade on and sell as a care business due to the age of the property and the extensive remedial work that would be required as part of the care inspectorate re-registration process. That's something that is fairly common, and the care inspectorate insists on remedial work to modernise and bring the homes into line with current requirements over an agreed timetable, and that's then in exchange for providing the care registration to a new operator. MHA Auchlacan has been slightly more challenging. It's involved the ongoing trading of 2 care homes and a retirement village with 235 residential properties over a 50-acre site. The company had historically relied upon support from its parent charity to fund high-level void costs at the village, as well as capital expenditure projects. Additionally, there were several arrangements with retirement village residents that had involved a level of subsidisation of service charge costs, and these had been agreed when the property had been sold to the residents. A high number of residents also benefited from agreements where the company were obligated to buy back their properties at a set price. Despite attempts to resolve these issues out with a formal insolvency process, these were unsuccessful, and that resulted in the parent entity deciding it could no longer sustainably provide ongoing support to the company. The care homes they owned by MHA had also experienced mixed fortunes, one consistently being loss-making despite almost being at full occupancy, and the other being profitable on occasion, despite a vacancy level of 10 to 20%, and we'll touch on the reasons for that during the course of this presentation. As administrators, we've been trading that business for over 16 months, which continue to operate 2 care homes, as well as providing care at home for some residents within the retirement village. And here's a quick picture of Hawking Garden Village for you. As you can see, it's quite a sizable site. So in terms of the current landscape, Scotland actually has an increasing life expectancy, which is driving an increase in demand for care services. Now, the majority of these are actually delivered by the private sector, with local authorities closing many of their own care homes due to budgetary pressures, with a preference now to rely on the private sector to deliver services at a lower cost than what local authorities can deliver. Now, recent examples of local authorities closing their own facilities include Edinburgh City Council, who just earlier this year closed 2 care homes they operated, and South Lanarkshire Council have also recently closed another care home, having already closed several over the last few years. Private sector operators have themselves experienced increased costs due to inflation, difficulties recruiting permanent staff due to shortages encountered following both COVID and Brexit. And that has led many care operators to rely on agency staff, which are generally far more expensive than employed staff and not always as efficient. And as we'll see on our next slide, there are limited opportunities for providers to increase revenues. So everyone in Scotland over the age of 65 is entitled to a personal care allowance, and I've provided figures above, and that depends on whether they just need personal care or nursing care. And that's not means tested, but it is assessed as being needed. Now, when someone's required to move to a care home, there are generally 2 categories they'll fall into. They'll either receive support from the local authority, who will fund their care through the National Care Home contract, or they won't be eligible for support and will be a private fee payer. Now, I have noted on the slide the amounts paid by local authorities under the National Care Home contract, and you'll probably note they fall well below the average weekly costs of living in a care home. The National Care Home contract is adjusted annually and is negotiated between Scottish Care, which represent independent care organisations, and COSLA, which represents all 32 Scottish local authorities. Now, there's been significant controversy in recent years regarding the rates negotiated between COSLA and Scottish Care, because Scottish Care have advised that they don't cover the full costs of delivering the services, leaving many organisations relying on private fee payers to pay a higher price, and there's an argument they effectively subsidise local authority funded clients. Now, the National Care Home contract rate is supposed to cover all costs and allow for a 4% profit margin, but those costs don't include financing costs, remedial work to property, the higher cost of agency workers, and if Scottish Care have claimed, it doesn't really appear to have fully accounted for the cost increases that members have experienced since 2020. Now, you might be wondering why care homes don't just focus on private fee-paying clients and stop providing care to local authority-funded clients. Well, some operators do, but for the majority, and you'll see from the overall split on the slide, 65% are effectively publicly funded clients, and that's going to be difficult for care providers to just simply discount local authority funded clients. And outside of large towns or cities, particularly in rural areas, the majority of the client base for care homes is local authority funded clients. Now, most profitable care homes will have the right mix of private and local authority funded clients, and some operators will also have care homes in geographically close areas, meaning they can take advantage of economies of scale. Practically, we've seen this during our appointments, with one of the homes I mentioned earlier being populated predominantly by local authority funded clients, and the other home benefiting from a good number of both private clients and local authority clients. The home with the predominantly local authority funded clients has experienced consistent losses, whilst the home that has a more favourable mix has been mostly profitable. Now, I'm also going to touch briefly on care at home, which is becoming more of a focus in the care sector, because care home places remain pretty static at the moment and are potentially dropping due to the closure of local authority facilities, and you would expect that the increasing age of the population would mean that care home places would actually be increasing, but that actually isn't the case. There's been a shift in focus now from placing elderly people into care homes to now allowing them to receive care within their own homes or within the community where and when their needs can be met. That's something that has led care homes to have vacancies more recently, something that hasn't really been seen too much during COVID, and that was because there was additional funding in place. Local authorities have, however, been asked to make cuts to their budgets, and that has led them to make some difficult decisions. So there is now a focus of trying to provide more care for people at home. So you might expect then that the local authorities might be trying to pay a higher rate to fund the costs of that. However, a similar position to what we're seeing in the care home sector is subsisting in the care at home sector, with the average hourly rate paid for care at home, the vast majority of which is actually local authority funded, being £21.43 in Scotland. However, the minimum hourly cost of providing that care is £25.48, and that doesn't account for the £1 and £2 profit element you'll see on the graph in front of me. And that is pretty much the case throughout the UK. It isn't just in Scotland, with I think only one region throughout the UK actually covering the cost of the care being provided. So these market conditions are leading care businesses to experience difficulty, and unfortunately there isn't actually much opportunity to generate a profit, and it's perhaps not surprising then that new entrants into the care home sector and the care at home sector are pretty static. And as you'll see from the graph in front, there are just under 10,000 people at any one time either awaiting assessment for social care or having been assessed as requiring a care at home package but awaiting resource to be allocated. So basically there is quite a number of people just sitting waiting. It's about 3,500 once they've been assessed, because the local authority simply doesn't have the resource, and that's partially due to the lack of new entrants into the marketplace and staffing issues in terms of the people who provide that care. So moving on to the more practical aspects of being appointed to a care business. So I'm kind of presuming I'm going from the point of view here where you might be anticipating trading on the business, and of course planning is an important part of that pre-appointment process where you are going to be deciding to trade on or considering trading on, and that will be predicated upon many factors, including the benefit to creditors of doing so. In Balmano House, a valuation of the property actually demonstrated that the ongoing trading was likely to achieve a lower value for the property, which then supported our decision to undertake an orderly wind down of the business, as the property was likely to achieve a higher value as a property development opportunity than it was as an ongoing care opportunity. On MHA Hawking, we were actually fortunate to have sufficient funds available to allow us to continue to trade on the company with a view to sale of the various components of the business for the benefit of creditors in due course. Detailed cash flow projections are obviously key to determining the period for which the business may be able to continue to trade, particularly if the intention is to achieve a sale of the business. Now, at the moment, the care inspectorate is taking at least 6 months to re-register homes, which is required when you're passing a home on to a new owner. So dependent on the strategy for the trading, you may actually have to carry on trading for a longer period than you would normally anticipate. However, I am aware of sales where the proposed purchaser has been able to take on the home under a management agreement in order to minimise the impact of this on the insolvency, but it won't necessarily be possible in all cases, so you will probably want to take that into your considerations and factor that in. Now, the care inspectorate and local authority do prefer advance warning of an impending insolvency where there's care involved, and whether you do or not will depend on your strategy. There isn't actually a requirement to tell them. However, if you're going to cease trading on day one, in conjunction with the directors of the business, I would suggest it could be very beneficial to have advanced discussions, both in order to ensure that alternative arrangements can be made for the people within the care home or for people you're providing care for, and also to help you provide a wind down of the business as well. It's unlikely that a local authority is going to be able to move people on day one if you just inform them on the day you're appointed. So what will often happen is that you'll be asked if you can facilitate trading on a fully funded basis for a short period of a few days to provide the local authority sufficient time to move the residents. In a care at home business, that's going to involve alternative providers providing the care packages, and the local authorities fortunately will have lots of providers that they can provide packages to, and may be able to provide short-term care whilst that's being arranged. Also, if you're dealing with a charity, remember there's a requirement for directors to obtain the consent of Oscar if you're undertaking a liquidation. However, there isn't that requirement to do that pre-appointment if it's an administration. In terms of planning, then, insurance is one thing we've encountered has been a significant issue. Lots of care home businesses require to maintain medical malpractice cover, and that isn't something you'll normally get on your open cover insurance. In Balmano House, we were actually able to continue on the pre-appointment policy with appropriate amendments and waivers to protect us from historical failures to disclose events. On the other MHA, we weren't able to carry on the pre-appointment policy, but fortunately our insurance broker was able to provide or obtain cover for medical malpractice cover, but it wasn't that easy to obtain. So again, worth having conversations with your broker in advance, and if you can get a copy of the insurance policy in advance, even better. Data protection is also a significant consideration. Care businesses tend to have large amounts of both paper and electronic records, and some of that will actually be special category data around about the health of clients. You should ensure that you have policies in place for safeguarding that data, as well as for the retention, destruction and transferal where appropriate, and that would be potentially when clients are moving to a new provider. You might have to pass on some of that information, so it's always useful to get some legal advice around that. In terms of the post-appointment period, on a formal level, I appreciate that residents, clients will not necessarily be the most important stakeholder when closing or trading a business on. There will be a period that you are potentially going to be responsible for the care of some people. So given the human aspect here, I would expect they would become pretty high on your priorities, particularly around communicating with residents and clients and next of kin. We found that vitally important on both Balmano House and MHA, and we held meetings with residents and next of kin to advise them on what was happening as soon as we were appointed, and also regarding what our intentions were on the ongoing provision of care. Now, if you're going to be seeking a sale of the business, you want to retain as many residents as you possibly can, so you don't want them to move on or to find new care homes if you're going to be seeking to sell the business. On an MHA, we've actually been able to increase the care home ratings despite the administration, which I suppose demonstrates the value that a good management agent can have during the course of an appointment. Now, if you're trading on, you are going to want the assistance of a qualified management agent, and I'm talking trading on here beyond the period of just a few days. If you're trading on for a period of 16 months, like we have done in MHA, you're going to want a management agent to assist you, and without it, the care inspector are highly unlikely to permit trading beyond a short period of a wind down. The agents will normally attend the site on day one and carry out immediate risk assessments, advising of any concerns, particularly around about health and safety, which can often be neglected in failing care businesses. And as an IP, you'll have to make an assessment in conjunction with the management agent on what health and safety matters are actually essential and which must be rectified immediately, or which can maybe be undertaken on a periodic and staged basis. The management team will generally manage the day-to-day operations of the care business because as IPs, we're not experts in care, and the management team will generally manage all of the staffing rotas, eligibility to work in the UK, liaising with suppliers, making sure that resident care plans are up to date or updating them in conjunction with the care staff, resident contracts, even liaising with the police where there may be investigations into the cause of death, and that's something you're always going to encounter in care homes and care businesses. They'll also generally deal with financial information and billing, and they'll have experience of dealing with the local authority and care inspectorate to help maintain good relationships and also help as part of the sale process. On MHA, we have had regular meetings with the care inspector and the local authority, and the management agent has been extremely useful in that regard. Staffing is also a key part of operating a care business, and liaising with staff in care in day one, is something that will be key to ensuring you can take control of the business and ensuring it continues to run smoothly. Communication with staff throughout is extremely important. They're going to be concerned regarding the appointment of an IP and will be well aware, I'm sure, of jobs available to them elsewhere. However, there'll be key members of staff that you'll want to retain, certainly the care manager, and it's often beneficial to potentially incentivise those key members of staff in order to retain them. And don't neglect the remaining staff, because maintaining a certain level of staff is key to be able to operate a care home, and dependent upon the number of people you provide care for, being understaffed could actually lead to the residents being removed from your care or restrictions on being able to take on new clients. Suppliers and debtors are also something that we found to be particularly problematic as well. Some suppliers have been extremely difficult to deal with, and again, a good management agent will have links and relationships with suppliers. So if you are having difficulty with some suppliers in terms of asking for upfront payments, for example, then the management agent can usually help with moving over those. Things like food supplies and health care supplies are vital to the ongoing trading, and agency staff as well. An early contact should be made with any agency staff provider in order to make sure that staff are going to be provided on an ongoing basis. Debtors, often care businesses will have significant debtors on appointment, and these can be due to billing anomalies that the local authority have encountered, or due to poor record keeping and billing practices by the former operator. Obtaining the pre-appointment records is key, as well as liaising with the local authority to try and collect these balances in. So that's been a bit of a run through. I'm sure we'll talk more in the panel session around some of the wider issues in terms of the care sector, but in terms of the key messages, it's all about planning your strategy. If you're obtaining a good management agent with experience of assisting insolvency practitioners, and always having regard for those you're providing care for and to. And thank you very much. I'll pass over to Shona.
Thanks, David, for that session. And yeah, you'll be just hanging about in the backstage area while we listen to our next presenter, Callum Carmichael, who's a partner at FRP Advisory, more than 25 years experience advising businesses at all stages of the corporate life cycle. Licensed insolvency practitioner, has a wide variety of sector experience, including hotels, oil and gas, paper manufacturing, and today's subject, fisheries. Callum.
Afternoon, everybody. Thanks for the wonderful introduction. Yeah, I for my sins have dealt with a few aquaculture related subjects over the last few years, most notably Dawnfresh, which I'm going to talk to you about today. But I thought I'd quickly run through what I was going through, just what I'm seeing in the current landscape and the challenges, the specific issues related to sort of aquaculture type businesses, and then quickly move on to the Dawnfresh presentation. So, and I know a lot of these subjects have possibly been or have been covered by other speakers, but I thought I would quickly run through where we're seeing things. Liquidity is an issue, largely as a result of interest rates still causing problems. You know, various funders are reluctant to fund ongoing problems just with the cash flow difficulties that they're facing. And you know, the secondary lenders seem to be taking over from the mainstream lenders in terms of taking action where they have problem cases. So that's been seen more activity. HMRC obviously post-COVID reverted back to business as usual, but recently there's as a result of the change of government, they had to appoint a new Advocate General, and that seems to have slowed things down a little bit. But although I noticed in the Gazette today there's a number of HMRC petitions are going through. That then leads on to other people taking action if HMRC are pushing. Some of the sectors that we're seeing, obviously food manufacturing, production, fishing, which is what I'm here to talk to you about today, but we've also seen construction, care sector, which David has just gone over. Just on that front, I would say the engagement with the local authority and the care inspector is critical if you're thinking of trading on, because overnight they can just decide that they're moving parties or refusing to have new residents come in, and that can seriously impact your business going forward. Anything with manufacturing with high input costs, and the one more recently that we're seeing a bit of activity is on in charities. Clearly there's a public sector public sector cuts happening, and that obviously has the knock-on effect into the third sector with charities. Difficulty there is it's a charity, and therefore, unless it's an older business, an older charity, sorry, it may not have very much in the way of assets in which to deal with. So moving on to aquaculture in particular, what we've seen, or the issues that were raised when we were dealing with Dawnfresh, is the rising costs, particularly feed. That's one of the main factors of any agriculture stroke aquaculture type business. Most notably, just as we were appointed, Ukraine was starting, so animal feed is largely based around wheat and such like, and the cost of that has risen tremendously over that period. Coupled with maintenance, you're dealing with cages that are in water. It needs regular maintenance management, and then linked with that, where you've got processing type facilities, it's the cost of freezing, processing, and the maintenance of the stock once you've processed it. Environmental management is also key in aquaculture, because it's a focus, like in any business, with the care inspector in the care sector, you have SEPA and Marine Scotland challenging everything that's done with aquaculture. And the regulatory pressures have only increased over the time with increased compliance. And in fact, there's a move now towards potentially onshore type fishery processing, where you have a sort of sealed container with tanks with water which are constantly recirculated, but it's all dealt with on land rather than the regulatory issues of dealing with it out in the freshwater and saltwater. Market competition for Dawnfresh, it was predominantly a trout farm business, but it also did processing in the salmon sector. Production is around about 7,500 tonnes in the UK, as opposed to 200,000 tonnes of salmon. And there is the salmon market is the predominant market, and it seems to be increasing. And there's pressure, particularly on where the fluctuations in demand, where it becomes slightly more fashionable. I've seen of late, there's a lot more trouts in restaurants and stuff like that, which drives more demand, but that can change very, very quickly. Brexit did have an impact. We all saw the TV footage of lorries being unable to cross the ferry at the time. I'm not suggesting it's like that now, but certainly the level of documentation and hoops that you have to jump through to get your product out of the UK has increased, and that has a cost attached to it. Profit margins are not as high as you would expect. Dawnfresh was slightly nuanced in that it had a mixed portfolio with the processing and the fish farming, and I think through the intercompany balances there was support given from other elements of the business to make the Dawnfresh margin look better than it was. So in 2020 it was operating about 20% EBITDA, but by 2023, just when we were selling the business, once we'd stripped out all the issues and tidied up the accounts, it was actually operating at about 10%. That, coupled with increased costs, was always raising pressure on the business. The main issue with the business, which leads on neatly to Dawnfresh, is the environmental aspect. Until I'd started working in this sector, you don't appreciate the issues with disease, pollution, environmental impact. So drought being one of them, which seems counterintuitive when you're dealing with fish farms, but I'll come on to that shortly. Pollution, from farming nearby with the chemicals coming in off the land, that can have an impact. Also things like density of fishing, depending on your programme, you might have more fish in the cage, and that leads to other issues with the fish rubbing up against each other, sea lice, and it becomes to the detriment of the fish. And there's also more concerns through the regulators in terms of the environmental impact of fish farming on the indigenous species that are round about where these farms sit. So turning now to Dawnfresh, it's a picture of Loch Etive, where the main site was operated for Dawnfresh. It was at the time the largest trout fish farming business and one of the biggest seafood producers and processors, which employed 600 people. It had 2 fish processing facilities, one in Arbroath, one in Uddingston, and 7 fish farms around the UK, with one of them for the hatchery over in Northern Ireland. Historically, this had been funded by the shareholder, Mr. Salveson, and he had invested heavily in the business. And his vision was to build a facility and then create a market to fulfill that facility. He did manage that to a point, but particularly with the Uddingston site, it was greater than the capacity that they could produce and others could provide them. And ultimately, it was loss-making, and it continually was funded by Mr. Salveson. But there came a point where he was experiencing cash flow issues in excess of £10 million. And this was then exacerbated in 2020 by the company experiencing a drought. Now, to explain, they operate in freshwater and sea lochs. Where you have a dry summer, which there was in 2020, the lochs are surrounded by the mountains, which usually has, and they're predominantly over on the west coast, where they have higher levels of rainfall, which washes into the sea and makes the salt water less saline. When it's less saline, you have less prevalence of what's called sea lice. And if you get sea lice to a certain level per fish, you have to unfortunately cull the harvest. And in 2020, the sea lice was getting to a level which was dangerous, and they took the decision to harvest the fish early, which was a significant cost because they had to bring in specialist boats to offload or take up the fish, and also the fish were underweight, so you had lower sales value with a much increased cost, and the position was becoming increasingly difficult. The company had been, as part of this, they decided to resize the business and move operations to Arbroath, but that was only part of the way through. And we were introduced to look at, in an advisory capacity, to look at the transition plan and to look at contingency planning. But when we looked into it, it rapidly became apparent that the transition plan was not going to work, and the original estimate was far greater than they had originally understood. So, just by way of a background here, this was the group structure of the company, with holdings sitting at the top. Seafoods is the main processing plant. You have Spinks off to the side, which was a specialist plant in Arbroath that did smoking of fish, patties, that kind of thing. And its largest customer, about 60% of its turnover, was Marks and Spencer's. And then over to the right, you have the Dawn Fresh farming business, which traded solvently throughout, and ironically, if the group structure had been set up slightly differently prior to our appointment, the Dawn Fresh farming would never have entered or been involved in an insolvency process. So hopefully you can see that okay. There were a number of issues that we needed to deal with. Spinks was a standalone business which did processing, and its largest customer was Marks and Spencer, so it was very attractive. So we wanted to run a pre-pack process with that, but we had engaged with Marks and Spencer's prior to that, and they were amenable to a pre-pack process being run as long as it was one of their approved suppliers. So we did that in a very short time scale, and fortunately we were able to secure a purchaser, Loggie Seafoods, who took on all the staff, and that was completed shortly after appointment, saving 200 jobs in the Arbroath area. So then our focus then moved on to the Dawn Fresh Seafoods, which are the main processing plant, which is about 300 staff. Clearly couldn't support that going forward, so we downsized that to about 60 staff in order to continue processing the fish that was being harvested out of farming and any other smaller customers that we could do. And the focus there was dealing with the massive amounts of frozen fish stocks that were there, and how we managed to sell that on the market. That was an interesting period of time, trying to deal with all sorts of weird and wonderful things that have been kept in freezers for 2 years and you think your food's fresh, but I can assure you folks, when you're almost 2 years after it's been frozen, it's still regarded as fresh when it comes to you in the supermarket. We then set about stabilising the farming business, because clearly it was a period of uncertainty. We changed some of the staffing, gave them incentives, and also engaged with with SEPA and Marine Scotland to ensure they were compliant with all the issues there, and essentially just steadied the ship. Key to that was securing funding. Mr. Salveson did ultimately provide funding, but it went backwards and forwards, and with the benefit of hindsight, we would have done things slightly differently, and that's one of my key takeaways, is getting that sorted earlier in the process. Beyond that, we marketed the Uddingston site, which could have been for residential use, but fortunately for us, somebody else wanted it as a facility, and we were able to secure excellent value for it and preserve the employment of the remaining staff that we had, and that it completed about 6 months after we were appointed. So at that point, we've dealt with the bulk of the assets. We could then turn our hand to the farming business, which had by this point had been stabilised. We had also transitioned the fish processing to third-party providers, which had been a challenge and was part of the reason we traded for 6 months whilst at the Uddingston site to facilitate that. Over and above that, we had holdings which had a building next to the Arbroath site, and that was a fun day in the office watching the auction of that when it had been valued at £50,000, having been bought for nearly £1 million, and ultimately it sold for 300,000. So I think that was a decent result in the end. So through our CF guys, we ran a full marketing exercise, and Maui, the main salmon producer in the UK and across the world, acquired the business as a trout fish farm and has continued to trade it as a fish farm, albeit we understand there are changes afoot and that it might ultimately become hatcheries for other breeds of fish. But that took almost to the day 12 months to complete, and from there we've then been dealing with the statutory duties of the case. So the outcome for creditors, and this is the first time I've ever done this in 25 years, initial estimates were that we would sell the business for between 18 and 25 million, and as a result we thought that would be a better result than a winding up. We were fortunate in that we managed to sell the farming business for 35 million, the Uddingston site sold and other associated assets sold for 7 million, and there was also bank interest and other bits and pieces, so we realised in total 45 million. So from that, we were able to pay off all creditors in full plus statutory interest. The Spinks business, that partially paid off the secured lender and the secondary prefs, but unfortunately, initially our estimate was that there was going to be a significant intercompany balance coming across, but once we were appointed, it transpired that the certain accounting had not been dealt with. And once we made those adjustments, there was no return. It basically flipped 100% the other direction, and they ended up with a 2 pence in the pound dividend. Seafoods has just finished. Spinks will be finishing very shortly once the various dividends have been cashed. And I'm in the fortunate position we've got 8 million quid to pass up to holdings and will ultimately go to the preference shareholders. So a great result for the creditors. The issues, much in the same way as David mentioned before, that I would take away from this, particularly on the trading side of things, was engaging with the key suppliers. Now, as I mentioned before, the feed supplier was the main one of the main costs of the farming business. There was a significant balance outstanding at the date of appointment, and there was a real risk that the food supplier and the feed supplier, would walk away, in which case we would be left in a very, very difficult position in requiring significant greater funding to manage the situation. Fortunately, through engagement with them, we were able to agree a repayment programme. They did, as a consequence, increase their prices going forward, which they suggested was something that was going to be happening anyway, but I don't doubt that the insolvency position was a catalyst for them doing that to protect their position. The engagement with staff, I think, was the main issue there, in that we had to make certain promotions in staff. There were staff that were already leaving, so we had to promote other staff. Salary rises, you're dealing with staff in rural locations, and staffing in these places is actually very, very difficult. So in order to preserve that, there were incentives provided, which some of which were just cash bonus payments for sticking with us, and then the main one was on the basis of a sale of the business, and that way it was to protect ongoing harvesting and work whilst the sale was going on, and that seemed to work quite well. The other thing is, never underestimate nature. It has a nasty habit of coming and kicking you right between the legs when you least expect it. We'd been through the drought, and it's a continual issue during the summer for the fish farming sector. But the other issue we had was kidney disease for the fish, and it was more prevalent in the eggs and the smolts. You get varying grades of fish as they grow to certain sizes. They're called different names. But we ended up with at the hatchery in Northern Ireland, there was testing carried out on a weekly basis, and there was the prevalence of this kidney disease, and it was becoming increasingly prevalent, and it was moving from cage to cage despite the fact that they're not directly connected. So we had to make the unfortunate decision to cull about 4 million fish, which obviously had a knock-on effect for the next harvest, but we were able to manage that over a period of time. Sea lice, as I mentioned before, is an ever-present problem for trout and fish generally in fish farms in the sea, and it requires ongoing management, and you need to be on top of it to make sure it doesn't become a critical issue. On the financial side of things, as I mentioned earlier on, securing funding for ongoing trading is critical. And whilst we did get that funding through Alistair Salveson, there were times where we had alternative funders, secondary funders, who were prepared to provide the money, but obviously they need to do their due diligence. That takes time, and where you're in a time critical position, it's not an ideal scenario. It was sorted, but it's something to always have in hand. Taking tax advice, now I know you were getting tax advice earlier on from RSM. It wasn't them that assisted in this particular case, but it is always useful to involve your tax advisor, because our issue with the farming sale was one of concern with the sale of the shares and whether or not there was going to be tax implication, but by virtue of the substantial shareholder exemption, that meant there was no tax paid. And then on the finance function, we did retain the finance function in seafoods, which covered, it covered all the group companies. But suffice to say, you want to retain them for a period of time to steady the ship, but don't be afraid to change things. And in fact, we ended up outsourcing a large proportion of the finance function, which in going forward actually benefited the purchaser and the transition of the business. Finally, a couple of statutory issues that we came across have probably been discussed by the legal advisors. We had Bank of Scotland as the secured lender. They were approving, by virtue of the appointment, they were approving fees and holdings, but they were paid off very quickly through the sale of the Uddingston site. But they have continued, or had continued up until it was converted to liquidation, to approve all the fees despite the fact they'd been repaid in full. And so we had interesting discussions with the legal advisors to make sure we were still carrying on correctly with that. And then the other one on seafoods, we'd obviously gone initially with option B, which was a better realisation and winding up based on our estimates of the farming sale. Clearly that changed and all creditors were paid in full. And so there was also a debate about whether or not we should have been seeking the court's approval to change it to option A as a recovery as a going concern. no was the answer, the ultimate answer to that, but it's one of these things you don't come across very often. And then finally, the slight nuance I didn't know about was on the payment of the statutory interest, which is at 8%, unless there's a contractual arrangement to the contrary. And we did have, I think it was half a dozen to 10 suppliers who did actually have different contractual rates, which we had to honour in the process. I do have a final slide just on other cases we dealt with, but I'll leave you to discuss that or to look at that in future. But hopefully that's given you a bit of an insight.
Thank you very much, Callum. So Callum's just going to hang around, and we're going to welcome back all the other speakers from our sector focuses that we've had so far for a panel discussion. So please send in your questions. We've got 5 licensed insolvency practitioners here on the panel. Just to introduce them again, and I don't know which order that you're seeing them in, but we've got Adele McLeod from Teneo, who was dealing with construction and talked us through Stuart Milne house builder case. We've got Richard Bathgate, who talked us through agriculture was the topic, and it was Balgownie administration. David Meldrum talked us through care homes and a couple of care related elderly people, older people care homes. At James Dewar, who did the will case and retail, and Callum Carmichael, who did aquaculture rather than fisheries. So I think brilliant opportunity here. We've got, I've worked it out in my head between the 5 of you. You've got over 100 years of experience. I think the other thing that's quite interesting is, and I haven't been and checked this, but I think that 2 of you have only had a license within the last 12 months, but still lots and lots of experience. And I think it's really reflected that a lot of us in the industry do have many years of experience before we actually become brave enough to actually put our name on the ticket and get a license. So the topic of this panel session is looking at how the strap line, looking at how your sectors have fared in 2024 and the key challenges that they're facing and how IPs might assist. So just to start the discussion, pending anything coming in from the audience, I'm going to ask each of you in turn just to briefly state, how's your sector fared in the last while? Do you think that there will be an increase in insolvencies in that sector? And if so, what are the specific factors driving that? So Adele, I'll go to you first.
Thanks, Shona. So I think in the roles that we all do, we tend to be understandably focused on the downside risk and distress across these sectors, but the indications are that construction overall is actually showing signs of recovery following a relatively turbulent period whilst interest rates were rising. The impact of increased materials prices was worked through, and the trust mini budget disrupted markets generally. And that's supported by recent Construction Purchasing Managers Index data, which is a bellwether for the sector. That said, the housing market is a weaker subsection of the construction sector, which is obviously very broad, and the housing sector is facing multiple challenges. And thinking about what we're seeing in terms of larger business failures, there haven't been many administrations in Scotland at all in 2024. And Stuart Milne is the most sizable construction sector appointment in terms of its scale and the impact on subcontractors and suppliers. And the MSPs and MPs that we spoke to in the course of the appointment were very concerned about that, but the supply chain in construction has proved to be very resilient in the first half of the year. And then will we see an increase in the number of construction failures? My feeling is that we will, but I would attribute that to the thin margins which are a feature across the sector. This means that construction businesses are susceptible to factors out with their control, such as regulatory or legal changes, as well as issues with specific contracts, customers, or their supply chain. And again, taking Stuart Milne as an example, as Connor covered yesterday, that business had significant leverage for some time, and constrained funding meant it couldn't continue to invest in pipeline development and weather the multiple challenges it faced to bridge to improve market conditions. So I couldn't point to a specific factor which would say will trigger a wave of construction sector insolvencies, but as is common across sectors, there will be businesses which don't have strong balance sheets or where management expertise and controls issues increase the likelihood of failure.
Okay, thank you, Adele. Richard.
I will summarise the agriculture sector. I was told by a farmer yesterday, just say up corn, down horn. And I think that's probably a pretty good way to remember it, is if your grain prices are going up, that's great if you're selling grain, if you're an arable farmer. If you need that grain or the inputs to feed livestock, your costs are increasing. But so far this year, rising costs and things are not as bad as they were at the start of the Ukraine war. Colleagues here who are farmers are saying they don't expect any significant change in the number of agricultural insolvencies this year. I think bank lending has been pretty conservative to the sector. Probably the only thing you might see is if you bought land and taken out the debt at a high interest rate. Now you might be starting to feel the pinch in servicing that debt. But I think in agriculture, it probably feels case specific. Is there some particular driver based on a particular business that would cause something? It doesn't feel like the sector is showing any particular signs of stress for 2024. No more than normal, and it's quite cyclical.
Okay, thanks. I'm just going to keep in the order that you presented in. So James, that means you're up next.
Yes, thanks, Shona. As far as retail is concerned, it's a really big sector in terms of both breadth of types of retailers and also the depth within that. You've got big, massive organisations and small ones. And given the number of players in that market, competition is fierce, and there will be winners and losers out of that. I think 2024 has been broadly similar to 23. I think the number of insolvencies has reverted to pre-pandemic levels, roughly about 2,000, 2,500 per annum across the UK. And I don't see that changing going forward. And I think it's also a bit of a mixed bag as to which part of the retail sector will be impacted by that. We're seeing online businesses going through restructuring processes as well as traditional bricks and mortar ones. So there's in some ways there's no rhyme or reason. Some factors affecting all retailers. Retail is closely linked to the performance of the wider economy. If consumers have money in their pocket to spend, then retail will generally do quite well. And the indications are that this continual, flatlining of the UK economy is probably likely to continue. I think labour costs are a big factor for retailers with the living wage going up in April. I think that will be a factor, and retailers will respond to that by continuing to look at the number of hours that they are opening, and may be making decisions to right-size their business. Shona.
Okay, sorry about that. Yeah. Okay, David, what are your thoughts?
I think it's been a difficult year again for care businesses in Scotland. Last year, Scottish Care advised that on average one care home was closing every week in Scotland, which were primarily small family-run homes in rural areas. I think there'll probably be a slight slowdown in closures this year, but we are seeing a number of kind of local authority homes closed down, as I touched on in my presentation. And despite the lower level of care home places available, the throughput coming through from local authorities seems to have slowed down. It has led to some vacancies. I think in terms of recruitment, that's continued to be a problem. Following COVID, a number of staff that worked in the care sector then went to work in the NHS. NHS workers tend to receive better pay conditions and pensions, and that, I suppose, it's had driven away employees from the care home sector, which has then led to a reliance on agency workers, and I still think that's a huge problem for the sector. And there's obviously been an increase in living costs and energy costs, insurance, maintenance and compliance all tend to be problems that care homes across Scotland are facing. And I think we've seen even larger operators over the last few years in terms of Four Seasons experiencing insolvency in terms of its parent, and a number of sales of those homes over the course of the past couple of years. And Bupa, another large operator, recently this year pulling out of a care home in Edinburgh. And Edinburgh is obviously a place that you would normally expect there to be quite high demand for those services. So there does seem to be reducing throughput for care home providers, and that's a problem for them. And we talked about in the presentation I had earlier on the low level of profit they're able to make as well. And ultimately that then leads to difficulties in terms of obtaining finance. I've spoken to a lender recently who had said that they had actually kind of ventured into the care sector market as being, available finance for them, but it was going to be under kind of very stringent circumstances, and they expected they would make very little to no lending at all, even though they were open to the right provider, and they expected in Scotland that was going to be extremely difficult. They may be able to provide some down south. So I think it's been a challenging 2024 for care businesses generally.
Okay, thanks. And Callum?
Yeah, I mean, it's been following Dawnfresh. There seemed to be a spate of cases that we dealt with, and sort of aquaculture related businesses, seaweed being one of them. And I think that's probably more down to, new product, and it's an early stage development, and it's not really taken hold in the market just yet. But I can see that these early adopters are the ones that have fallen by the wayside, but it may well be something big in the future. But general sort of fishing, they've dealt with the crab company, Fishermen's Society, Cam Fishing, the theme there has been increased costs and inability to realise the assets in a quick timescale, cash pressures and such like. So the mood music is that it's going to be staying the same, but as James mentioned, I think there's a sort of a definitive volume of cases, and overall that will not change over the period. It will just depend on the mix of things. Just on Adele's point about construction, I know Haddon Construction just went into administration last week, in fact, and whilst it's not residential house building, and that was your focus, I do think the construction sector, as you mentioned, is one that's perennially got difficulties because it operates on such thin margins, and it operates on the basis that once they've got the contract, they can get the extras via the quantity surveyor. Invariably, it doesn't work out that way, and you're left with that balancing account where there's a discussion to be had, and it's either cash now and the promise of some juicy contract, or you take your pain and you walk away. And I think to some extent on the Haddon one, that's probably what happened a bit there. I think that some of the projects that were taken on were very, very thin. Agriculture, to Richard's point, I think we have seen some agricultural stuff of late, but I think the issue there is that land values tend to hold up, and therefore banks tend not to be too problematic as long as they can manage their costs. And as you say, when the corn's up, the horn's down. I think that was the right analogy there. And then finally on the care home side of things, I suppose it's a question for David. Do you think the move from care to social care, care homes to social care, is possibly going to be a driver for care homes struggling going forward?
Yeah, I think it will be. The number of vacancies I think that care home businesses are starting to see is likely to become a problem for them. I suppose the difficulty is, despite the attempt to drive a focus towards care at home, there does seem to be a lack of care at home providers. I do think there's an economic argument here as well, in terms of there's probably a large number of people who probably normally would go into care homes but really don't want to because of the cost implications of doing so, having to sell their homes. And you probably find there's a hidden population out there who are really just being cared for by family members rather than being cared for through kind of traditional means, either through care at home or through the care sector. So I suppose they're probably losing out on that client base, and the majority of them are likely to be private fee payers as well. So I suspect the vacancies in the care homes are likely to continue to rise, and that's going to cause significant financial difficulties for them. And I think we're probably going to see more care home closures over the next couple of years.
Yeah.
So turning to what's the role of IPs and what can we do to help? Richard, what are your thoughts?
Generally, or the agri sector, or?
Yeah, I'll let you do agri first, and then in general.
I think probably comes back to we did talk about the communication theme a few times. There's definitely a change in a generational shift, I think, in farming, where there's more younger farmers are getting involved in the management because it's becoming more computerized. So I think we're finding with our client base, there's still a need for communication there to help people make that digital transition and move away from it all being paper to making tax digital and using your computer system properly to actually see where are you making money and where are you not. But also I think communication is really important when you see the social aspect of a mart and you go down, you see all the farmers having a chat. You know, if you're sitting on your tractor for 12 hours a day and you don't see anyone, or you talk to them on the radio, you know, that social aspect. So there's still something around hubs being, or marts being a sort of hub where you find out what's going on in the market and you talk to your competitors effectively. And actually talking to some of the marts, that rise in digital, what's a mart business going to look like in 5-10 years? Because actually if you can tag all your cattle and your sheep and prove their provenance, can you just sell them from your iPad? And so what's a mart's role going to play as that digitalizes? So communication, I think, will be the thing that sticks everything together and makes us all win clients, keep clients, and then deal with the issues that arise.
Okay, thanks. James, what about retail and the role of IPs?
Yeah, maybe broadening it away from retail and thinking about when IPs often get introduced to businesses is when there's a funding requirement. And instead of just lurching towards the restructuring toolkit, if you can find an alternative way to plug that funding requirement, be it through equity or refinance or some sort of new debt, I think that can be incredibly powerful. Oftentimes a business is, the relationship with their existing stakeholders may not be going very well. And so not only does new money solve the cash position, but it also sets the bedrock for how the business can grow going forward. If you're maybe moving further up the food chain and away from the kind of distressed situation, then there's the whole range of other services that could be provided to help businesses out, be those cost reduction exercises, profits analysis to understand the economic profitability of each service line within the company, and then if you flip back to if the business can't be rescued without some sort of restructuring process, then having time and space to work with the company before it gets to that insolvent point is super important. You can use that time to negotiate for retail landlords or whoever the other main stakeholders and creditors are across the business, and that may be able to buy you time to implement other restructuring solutions. If the business ultimately needs to go through a formal insolvency process, then I think IPs can add an awful lot of help in achieving a soft landing for that business and perhaps finding a way to rescue, maybe not the entity, but at least the business, and to save some jobs in the process. So overall, I think IPs have a really wide toolkit and a wide range of experiences, and can call upon deep sector specialists within their organisations that can really add a lot of value to many businesses.
James, just to add to that.
Turning to you. Sorry, Callum.
I know I was saying I totally echo what James is saying there, but the fundamental issue is being introduced to the company as early as possible. I mean, I know it's a mantra of all insolvency practitioners, but as James has pointed out, the earlier you're introduced, the more options you then have available in your toolkit to try and help the company.
Yeah, I think we've all been banging that drum for long enough.
Yes.
Yeah, so just turn to you, Adele, and I think that what I got from part of your presentation yesterday was that you were be surprised at how well everything's sold from all the sites, and in terms of, I guess that's about the availability of finance and money for people to purchase land banks and development sites, and indeed the options over land. So, I mean, where were these? Where was the funding coming from? Was it bank lending? Was it cash, asset rich, or and yeah, where was that?
Yeah.
What was that?
Yeah, I mean, it's probably worth, before jumping into that, it's probably worth calling out that there was a different level of interest for different sites and different geographies. So I think we found the northeast more challenging. As we all know, Aberdeen area can be a bit of a microeconomic climate of its own, and so there's definitely stronger demand across the central belt sites, but ultimately, strong bids for all sites, which was a great result. And I think it's partly attributable to that there is that lender appetite. As we mentioned in the presentation yesterday, some of the transactions were financed through debt funding, which is so there are opportunities for debt funded purchases in the right situations. But I think also we were dealing with pretty savvy purchasers. So very experienced boards of SMEs who are used to acquiring land assets from insolvency. There have been a number of house builder failures of different scales over the years, and a lot of the people we were dealing with had experience of that. So I think that really helps, because it's always an issue in insolvency, buyers getting comfortable with the terms which an IP will sell assets on, and also just the need to get comfortable with someone else's work on a development site. As an outsider looking in, that seems like a difficult prospect, but if you've been in the construction house building industry for 20 years, you look at it very pragmatically, and you know exactly who you'll call in to finish the works and what it'll cost ultimately.
Okay, I think that in terms of the sector, we've covered the sectors that you all had allocated. Callum, you mentioned that charities is something that you're seeing more activity of distress, and I certainly am seeing that too. I just want to elaborate a bit more about what some of the issues are there.
I think fundamentally you have charities who, for good and onerous reasons, have set up, but they haven't got the traction. They've relied on grant and local authority funding to fulfil their services, and unfortunately that is now being cut. So it's a case of looking at, do they have complementary services with other charities? Can they merge the businesses? And it's actually forcing people to have a think about, what is the future? It might not be quite what the original vision was, but it's a way of salvaging part or all of the business and making it a more unified entity at the end of the day. The issues you also have are with the ring-fenced funds as opposed to free funds, and in particular, a lot of these charities are, they operate for good and onerous reasons, and it's dealt with on the charity of trustees to help out with the governance and management of the businesses, and the staff who do it are doing it not out of the goodness of their own heart, but they have a sort of charitable bone in their body, but are not being remunerated particularly highly for it. So it's a challenge finding value in the assets to fulfill some kind of process. Also, some of the charities that are need to be regulated via the accountant and bankruptcy. I know for a fact that Kilgraston School, for example, that's going to be a sequestration because of its charitable status. So not everybody can be or is likely to be involved in those kind of cases, but where you've got big property assets, it's a case worth doing. But where there are limited or no assets in it, you can help on a bit of a pro bono basis and try and assist them, but it may not necessarily be the most financially rewarding exercise.
Yeah, I don't know, Richard, have you got anything to add on charities and the sort of insolvency routes that are available?
Probably just following on from the theme of independent schools, I think with the changes in VAT status coming up, I think there's quite a lot of schools competing for the same pupils, and unless they've maybe got something unique about them, it's often quite hard to keep those pupil numbers up. And there's a lot of schools, they're meant to be not-for-profit, so they don't necessarily have massive reserves to see them through a big transitional shift like this. So I think there's a lot of schools trying to plan for what's coming up, how you're going to change your revenue model. Can you earn additional revenue by hiring out facilities or something you might not have done before? But equally, I think it'll be interesting to see in the coming year or two how that actually feeds into the number of school failures, but also the pupil numbers. I think there might be a number of pupils come out of the independent sector and go to the state sector, and that's going to have an effect on taxpayers because we'll have to fund more state school places. So it'll be interesting to see how that actually comes out in the wash, but certainly I know there's schools where some parents are saying, well, I've got 2 kids, I've got a third one going, I'm not going to send the third one. It's just too much. Might be some more of that, and so that'll see how that comes out in the wash. But certainly I think there's some challenges on the horizon there, but most schools will be planning for that already.
Interesting dynamic in that family, Richard, if you've got 2 children at private school and the third goes to state school. I was
actually chatting to a dad on Sunday morning who's done exactly that. He's got 2 already in the system. He had 1 who'd done P1, and he said, look, we just got to take the third one out. Well, we can come back at secondary, but it's too expensive.
Yeah, and I think that's a general theme, is that there is a falling role of private school entrants generally. I mean, Edinburgh is an exception in that it's a greater proportion of privately educated than any place else in Scotland, but particularly with your more rural locations such as Kilgraston and around Perthshire, where there are a number of them, there will be conversations going on where fees are going up by 20% in the not too distant future. We simply can't afford that, and you're right, they will end up in the state school system.
We've had our first question. You want to a further?
No, I was just going to say there's a first question, which is for James, I think.
Yeah. So what we've been asked is, someone's bemoaning the state of Union Street in Aberdeen and the Murraygate in Dundee, full of smaller businesses, vape shops, fixture mobile shops, charity shops, rather than the big retail chains. And the question is that if the days of the large high street brands are over, is the skill set of the IPs in the future going to be more focused on the online e-retailer businesses rather than bricks and mortar businesses?
Yeah, happy to pick that one up. There's quite a few things in that question that probably need to be unpicked. I agree that there's been a divergence of the market. If you look at the Edinburgh St James quarter, it's full of high-end shops and it's doing very well. It's got very few voids and a list of retailers wanting to go in there. Similar vein, the discounters, the discount retailers have done very well as well. And I think that's the point that the question is making, that the bit in the middle, the brands that were on every high street with 1,000 units across the UK have struggled because the consumer has either been going high or going low or going online. And many of those businesses have gone. There's a few left, and I think they may be the survivors, because I think there will always be a requirement for an omni-channel model whereby people can buy online, but they can return in store, or if they want to go in store to check the merch, then they can do that, and ironically then go and buy online. I still think bricks and mortar businesses will face ongoing challenges from online retailers that can pop up at relatively low cost and try to eat their breakfast. But I also think that consumers do gravitate towards brands, and if you can deliver your brand with good service, I think that does count for a lot. In terms of the last part of the question, talking about the skill set of IPs, yeah, that will have to change. With an online business, the stock is there in a warehouse, or ironically, maybe it's not there, maybe it's in third-party warehouses, or it's in transit. But in some ways, the principles are the same. You still need to get a hold of the tangible stock, and you've got an intellectual property to dispose of with it. And I think in the online world, it's easier to separate those two and sell them independently, whereas in the old-fashioned high street model, everything's under one roof. So I think the skill sets will change. And to be honest, online's been with us long enough now that I think many IPs have had direct experience of dealing with that and know the specific challenges that faces. Hopefully that answers the question.
I don't think it's restricted to Aberdeen and Dundee. It could be any town and city in Scotland.
I was going to say there's a lot of brain power going into making Union Street look a lot nicer in Aberdeen. But I think it is the upshot challenge of all that is there's all these properties on a very long, cold, wet, windy street. And when you chat to surveyors, the challenge is what alternatively can you do with those? Because when they were stores, they're very deep properties without natural light coming in. So you can't easily convert them into residential or another use. It's almost, like a bat cave where you drive in at the back, have a big roller door, and then make a huge big residential place with skylights. But there's not a lot else you can do with it. And that's something they're still wrestling with up here, is how do you shrink the commercial space and turn it into something else? It's not an easy task, I don't think.
I think that's covered across many towns across Scotland and indeed the UK. And you look at even their cities aren't immune from that. In Edinburgh, it's very fortunate to have a big tourism, leisure, hospitality sector. So the Johnny Walker experience, for example, it's taken over the former Fraser's space. But the general theme is too much retail, and it's a real challenge for our town planners. What you'd place it with. You just can't have wall-to-wall residential in the centre of town. Otherwise, you're hollowing out the town centre itself. There's only so much leisure and hospitality you can put in there as well. So and I think that it's going to be horses for courses. Every single town has to sit down and come up with a solution that's appropriate for its specific situation.
Yeah, we saw that in Aberdeen, certainly on the shopping centres, the Bonaccord centre in Aberdeen, when we dealt with the administration of that, and certainly that was one of the huge challenges. Is retailers, you were desperate to get retailers in to effectively fill the space because of the void costs, obviously the service charge costs, and quite often would be the only thing that some of the tenants would be covering. And it's a huge challenge for landlords, because when you try and convert it to leisure, quite often the leisure operator incoming wants a large rent-free period, or they want a contribution from the landlord as well. So in order to actually attract them into the space, so it's a challenge for a landlord who's maybe not got quite very much cash to spend. And I think not just high streets but shopping centres as well, there's probably going to be a different future for them. In Glasgow, we've obviously heard about the potential demolishment of the Buchanan galleries and converting that potentially into residential space as well. So it's probably a sector that's going to experience huge challenges over the next few years, because I just don't see retail businesses returning to the way they were pre-COVID. I think most of them are now almost, as James touched on, almost kind of show homes effectively for brands in order for them people to then go and buy online, and I wonder if that might be the future for some of these retail spaces. They're effectively, you don't even buy in store, you just buy online, but it's a kind of a place to come and try before you buy.
Maybe a nice place for a care home for you, David. Just use one of those resi buildings, and Callum could get a wee fishmonger next door.
There you go. It's all about shopping local, Richard.
Richard's just solved all the sector problems there.
I think generally speaking, in the towns and cities, the town planners have been at various sort of surveyor presentations, and there is a move to try and bring more residential and more sort of social events, small museums, art galleries, that kind of thing, to take up some of the space and drive more footfall in the remaining areas. But it's not a quick fix. It's not something that's going to happen overnight. But undoubtedly, with the reduction on the high street, that space has to be filled at some point with something.
Sorry, right. I just lost my mouse there, but I remember James's top tip of hitting your space bar. So thanks for that, James. Yeah, so I think we'll just bring that panel session to a close now. We're just at the end of the second day of the conference. But thanks very much for all of your many years of experience and the really practical sessions, as well as the sector focus. I think when we were planning this session, and some of the feedback we got from the conference last year was just with COVID and the way that the insolvencies flipped from nothing trading to basically doing a lot of CVL shutdowns. There's some of our junior staff coming through have never really experienced being out on site and having to deal with some of the, a lot of the stakeholder issues that you all mentioned, communication in your presentations about how important that is, whether it be the employees or the families and the residents or the people who've just bought houses that they're not going to get, just how important that is. But a big thank you to you all for taking the time to prepare your presentations, present, and then also join this panel session. Thank you. And now it's on to me to do my closing remarks. So I'll name check all the speakers in a moment, but this has been 7 hours plus of quality CPD. It's been a lot of stuff, and I hope you found it helpful and useful, practical, relevant in terms of what you do in your job or your area of specialism. There will be a feedback question coming up, I think, just shortly. I'd appreciate if you take time to respond to that. There is going to be a link circulated afterwards as well for the watch up to watch again or catch up or recommend to people who maybe didn't catch it. I think there's a lot of quality content. I'm going to make sure everybody in my team has watched at least the monitoring review session, if nothing else. So just to go through our speakers again: Professor Russell Napier, Robert Mudge, Leslie Byrne, Joanne Wright, Stuart Clubb, James Lloyd, David Mingus, Yvonne McDermott, Andrew Shore, Tony Cochrane, Rob Pullar, Connor Bowles, Michelle Waugh, and then our panel there: Adele McLeod, Richard Bathgate, James Dewar, David Meldrum, and Callum Carmichael. And then behind the scenes, David and Brandon and Sarah in the green room, and George. And also we have a big thanks to Flo at ICAS. There's been quite a lot of people involved in ICAS in terms of preparing some of the materials that go along with this, but Flo's the one that's sort of been keeping them all in line, and Flo will also be organising the face-to-face networking event on the 14th of November. So yeah, that's all, folks, and hope to see you in Glasgow on the 14th of November.